I made over $100,000 in trading now with over $1 million in funding. And within 3 hours, I want to help you scale your trading performance by 10x. So without further ado, let's start now. And at the start, first we're going to do is look at what not to do. The 7 habits of unsuccessful traders. And once we know what not to do, we're going to focus on what to do. The trader pyramid, the exact framework that me and my students use to get consistently profitable with payouts. After we know what not to do and what to do, we're going over the third part, and that is how to make money, how to get funded within 30 days. And after that, we're going over the entry strategy, the exact entry model I use to gain over $1 million in funding. Are you ready? Let's dive in. The frameworks you're about to learn made me quit my 9-to-5 job and travel all over the world. And you might wonder, like, why give all this value for free? Well, it's very simple. Currently, I'm on a mission to help 10,000 traders become profitable before 2026. So at school, we have a massive free group. Of course, I have some private stuff, but this is all free, and I'm going to give you as much value as possible. Learning is 2 things. It's both focusing on what to avoid and stop doing that, but it's also on focusing on what works and double down on that. So first, in this teaching, we're going over the 7 traits of losing traders. So what do we need to avoid to become successful? After that, we'll go over the exact framework I use to become profitable, the trader pyramid, what to actually do. Before we start, quick disclaimer. 95% of traders lose money. That means 95% of the trading behavior, which you will see on YouTube or anywhere else, will not work in trading. So think about that. If you want to become the 5% of trading, you need to do what the other 95% is not doing. That's what we're going to teach you. We're going to focus on the 5%, like me, who makes money, and you very soon, I promise you. We're going to focus on what to do to be profitable and actually make money with trading. But remember, trading is the hardest way to the easiest money. The hardest part of this, we're going to tackle in this market mastery course. The easiest part to the easy money is you making money based on the frameworks you're about to learn. You should at least expect to spend 6 to 12 months on building your foundation, with the expectation of not making money and even losing money. And if this scares you, by all means, stop watching the video right now, go dropshipping, go affiliate marketing, and any other way to make money online. Trading is not for you. If you're still convinced you're going to make it with trading, amazing. Let's get to work. Before we start, do you have your notepad? There's no Netflix. Take out your notepad and let's get to work. There we go. First, let's start on the 7 traits of unsuccessful traders. So, what to avoid. First one is human emotions. We're going over them one by one. Human emotions. Your trading psychology. Lack of discipline. Lack of money. Unrealistic expectations. A lack of strategy or an edge. Lack of risk management. Or that limited belief that trading is hard, I can never make it. The barrier of entry. The first one is human emotions. The trading psychology. And to understand human emotions and psychology, you need to understand what's going on here in your brain. So if you do a quick Google search, how does your brain works, you find this picture. And you have basically 3 layers in your brain. The first one is your reptile brain. It's your instinct, your fight or flight system. On top of that, you have your limbic system. There's your emotions. And on top of that, you have your neocortex. That's your speech, your logic, your higher thinking. Trading triggers, automatically, you cannot do anything about this. Triggers your reptile brain, your fight or flight instinct. Oh no, I need to get out of this. I need to do this, You're gonna go on crazy. It also triggers your limbic system. Your emotions. While your trading decisions should be made at the neocortex level, the logical, higher thinking, the rational you. With trading, you will encounter a battle between these layers in your brain. The losing 95% is stuck in their reptile brain or the limbic system. They just cannot get out of that fight or flight or that emotional state. The winning 5%, where I want you to focus on, spends the majority of their focus in the neocortex. And there are tricks for this. We're going to talk about that later in this course. The second one is the lack of discipline. You need to be focused on intentional improvement. Discipline is a muscle. Like maybe you are now saying to yourself, I'm not a disciplined person. No, you're not, because you need to train that. Discipline should be trained consistently every single day. Focus on intentional improvement, go somewhere and not anywhere. And this is a brain tattoo I want you to remember. All change is hard at first, messy in the middle, and gorgeous at the end. So what I mean by that is when you're going to do something new. Can be trading, can be going to the gym, can be running, can be whatever new. It's going to be very hard at first. Your brain is going to find 100 excuses to not do it. It's hard. You should go away from that. Your fight or flight instinct comes above. Then your limbic system says to you, no, don't do that. When you overcome that, of course, that's also where your growth is. Then comes the second part, the middle. It's going to be messy. You're all over the place. You know that you're on the right track, but it's still so messy. You know on the right track, but you don't know when you're going to get there, how you're going to get there, to that change state you want to go. But then when you overcome that messy in the middle, it's gorgeous at the end. In trading, the first and the middle, especially the middle, is what most traders made them quit or lose all their money. But remember, there is something gorgeous at the end. It's very simple. What's gorgeous at the end is you making money in trading. You making money in trading to, get your family on a nice holiday, or quit your 9 to 5, or live on your own terms. Go to, the other side of the world because you want to visit the country. There needs to be freedom in your trading, and freedom is different for everybody, but it's gorgeous. So remember this, all change is going to be hard at first, messy in the middle, and gorgeous at the end. And here you see the intentional improvement graph. It's compounding. So here's the baseline. On the vertical line of results, horizontal line is time. If you focus on that intentional improvement, go somewhere, not anywhere, you will see at the start, nothing happening. But over time, the difference between you making a 1% improvement over time instead of a 1% decline over time is going to be massive. So that means also a death by 1,000 cuts. So maybe you don't know. So maybe you're not aware if you take that cookie or you remove the stop loss one time that you actually chose today to decline 1%. But what if you do that 100 days in a row? You're fucking fat after 100 days and you're going to lose all your money when you're going to remove your stop loss after 100 days. I guarantee you. So be aware that 1%, those tiny little details are going to make a huge difference. It's also about building self-respect. Let's go a little bit deeper. Discipline should be a focus on the charts and outside the charts. You will gain self-respect when you are doing things where you don't feel like doing them. You did not want to go to the gym, but you did. You did not want to eat healthy, but you did. You did not want to save money to invest in yourself, but you did. You did not want to sit on your hands and be patient for your next trade setup, but you did. And every single time you follow your disciplined self, the choice you make that will give you a better outcome, that 1% improvement in the long run, you will improve your self-respect. It's cool, right? But there's a flip side to this. Every time you do not follow your disciplined self, remember the death by 1,000 cuts, eat a pizza, going to the party you should not go to, buy that random shit you see on TikTok, I know you guys do this, you decrease your self-respect. And this compounds. Remember this graph, the compounding to the up and the downside? It's all about your self-respect. After, let's say, 50 days, 100 days of you actually focusing on that 1% over time, your self-respect goes to the roof. Like, yo, I'm not that guy anymore. I'm not that girl anymore who eats that pizza. I'm going for a run. Fuck those losers. I'm better than this. Focus on that self-respect. And this is the compound effect in action. Compound effect is choices plus behavior plus habits plus time. And it can be income, can be health, can be relationships, can be happiness, can be success. It's all the same formula for the different important areas in your life. So if your choices, behaviors, and habits align with a successful person, this one, you should be good. But keep in mind, the death by 1,000 cuts. So in this graph, you have 3 persons. The person here in the middle, just their choices are the same, their behavior is the same, their habits are the same. They just don't change anything. So over time, they will be exactly in the same place. The one on the bottom here, his choices were declining. He chose for the minus 1%. He didn't go to the gym anymore. He over-leveraged in trading. He stopped watching educational videos. He stopped reading books. He stopped giving attention to his family, to his friends. And over time, the first maybe few weeks, few months, they're all the same. But over time, there is a point where it's going to start to compound. For example, with his income. He doesn't have any income anymore. Maybe less. His health is declining because he's going to be fat because he stopped working out and he eats unhealthy. Maybe his wife is going to leave him because he doesn't give attention to it and his kids are abandoned. Because of that, his happiness goes straight down. He's not successful at all. And of course, there's a flip side to this legend here at the top who chose the other side, the 1% better. He chose to go to the gym, to buy that course, to be the disciplined person, to give his family all the love and attention he has. And those 3 guys, first few months, first few weeks, are all the same. But this compounds over time. Remember that acronym like, oh, this is an overnight success? This is the overnight success, but also your overnight failure. It looks all the same, but all of a sudden, when you focus on the 1% over time, you are ahead. You are at overnight success. So go focus on that. Remember that brain tattoo? All change is going to be hard at first, messy in the middle, and gorgeous at the end. Be very sharp on mistakes. Remember that 1% decline? It's okay to make that. Don't get me wrong. In trading, life in general, but you're here for trading, you're gonna make so many mistakes. And it's okay. It's completely fine to make them. But it's not okay to keep repeating them. And here's insights on intelligence and learning. I learned from Alex Ramosi. When you make a mistake, and you get feedback on that mistake, you should change your behavior to make the mistake again. You should change your behavior to avoid making that mistake again. But if you make a mistake and you don't change your behavior, you do not learn anything. You just be a donkey who makes the same mistake all over again. So let's say, example, you remove your stop loss. That's a huge mistake. I'm going to talk about that in a second. And your feedback is your account is blown because you took a massive loss. Well, okay, that's a mistake. It's okay. It was one time. But if you do not change your behavior, the next time you're feeling emotional, you do exactly the same, you don't learn anything. You just make exactly the same mistake again. And the only way to improve is by learning, is by changing your behavior based on the feedback you receive. And your intelligence is measured by how fast you learn. In other words, the speed you change your behavior based on feedback you receive. The faster you implement feedback loops, the more you learn, the more intelligent you are. So let's now agree with each other. We're going to be focusing on being an intelligent trader. So that means you make a mistake, the time between you making the mistake, change your behavior based on the feedback you receive, and then not making the mistake again should be as little as possible. And maybe at the start, you will make mistakes multiple times. But again, you focus on 1% every day. So that means if you made a mistake and your feedback loop takes so long, and maybe you make the mistake multiple times, if you make the mistake, the next time you make a mistake, it should be a faster, a shorter feedback loop. Be that intelligent trader, you can do it, I promise you. The third one is the lack of money. Most people starting out with trading think they cannot go to that 100,000 or more goal because they only have a few $100s to start with. Well, this cannot be further from the truth. I'm going to explain you why. You can go to 100K if that's your goal. Can also be more, can be less, whatever. Let's take it 100K. You can do it in two ways. Without leverage and with leverage. Without leverage is compounding your account. Another brain tattoo. I'm going to shoot your brain tattoos today, guys. Small steps done consistently over time yield stunning results. And with compounding your small account, it can be very significant. Let's say you want a daily gain of 1.5%, 15 pips stop loss. Your starting balance is at 1,000. This is how your trading account is going to be compounding after, let's say, 20 or 30 days. Of course, losing is not taken into account here, but this is an average to show the example of compounding. So you start with 1,000, and after 20 days, you went from 1,000 to 1,300. Well, that's not exciting, right? I wouldn't go trade if I would know, okay, well, I'm going to take 20 winning trades in a row and I only make 300. I wouldn't do that. But the power is in the compounding. Let's take a look at the second image. After 200 days, your 1,000 is 35K, and you're making 500 per month, 500 per day. That's something I'm more interested in. But before you can reach that compounding stage, and again, you can lose in between, so maybe this road will take a little bit longer. But you should know about the power of compounding. So the first 30, 60, 90 days are so boring. You build data, you just do what you need to do, you improve small numbers, you're building data on your trading and on yourself. But after that, I think most of you will accept a $500 a day win every single day or multiple times a week. So let's say if you can make 3 trades of $500, $1,500 per week, I think most of you will be happy with like a $4,500 extra income on the side from trading. And here you see that graph of compounding. Small steps, seemingly insignificant, done consistently over time, yield stunning results. And then let's talk about with leverage. And then you can use prop firms. A prop firm is a company that provides traders with access to capital. In return, the traders share a percentage of the profits they generate with the company. Prop firms can help skilled individuals propel their trading careers by providing capital, training, and general support. In other words, if you have read the Rich Dad Poor Dad books, it's traded with OPM, other people's money. And leverage is an investment strategy of using borrowed money, other people's money, specifically to use various financial instruments or borrowed capital to increase the potential return on investment. I like leverage more than compounding because I get more money for my unit time invested in my trading. And here's a little schematic on why to use a prop firm. The red arrow is a personal account, so the compounding we discussed with the without leverage part. What is the chance of you flipping $500 to 100K? It's not that high. You can do it, but it takes so long. You saw it, like you needed at least like 200 winning days or something. It is possible, but it takes a long time. And of course, the mental game of flipping, because you have losses in between as well, is difficult. That's why I like leverage prop firms. Because with that same $500, you can get a 100K challenge on most prop firms. A challenge is where you need to prove to a prop firm that you can trade. You have some goals like a 10% or 8% profit goal, maybe 2 phases. When you pass the challenge, you can actually trade on a prop firm. If you pass the challenge and you make 1 or 3% per month, that's an extra 1 or 3K per month consistently. But you can even go further than this. Even when you pass, let's say, 1 out of 5 challenges, because the challenges are hard. The challenges are made for you to lose because that's how prop firms make money. Let's say, hypothetical account. You buy 5 challenges of $500. That costs you $2,500. Of that 5 accounts, you only pass 1. You make a 3% payout. That's of course a 1 to 3 on a 1% risk per trade. Then you have a payout of 3,000. Of course, prop firms take their profit split, but let's hypothetical, you have the 100%. Your profit on the batch of 5 challenges, 5, is 3,000 of your payout minus the 2,500 from your initial investment. The buying of the 5 challenges is 500. So now you are in profit, and you still have that 100K account to play with for the next payout. And now you have some extra side cash to buy new challenges. And that's how you, of course, scale a prop firm empire. And even if you have, let's say, not a 3,000 payout, but an 80% profit split, so that's a 2,400 payout. Then, after the first payout, you already almost at break even. You're the minus 100. That's a good deal, because then you still have that 100K account to play with. So, traders who come to me who say, I don't have any money, I cannot start, I only have a few hundred to play with, there's no excuse. Or go compounding, or go play prop firms. I don't care which one you choose. If you do it consistently, just do it. The fourth one. And before we continue, I want to congratulate you to be still in here. Don't forget to take notes. Take notes, ask questions if you have them. In the school group, just make a post, question, and you should be good. And because I want to congratulate you, we do a little confetti here. Let's go to the fourth one. Unrealistic expectations. Is it easy money, trading? We discussed this earlier. Trading is the hardest way to the easiest money. You should not be here for the easy and quick money. Yes, you can make some money at the start, but the big money, the 100K plus, is not going to happen in the first week. It is. This also requires an incredible amount of determination, hard work, and be able to change the way you approach your life. You need to change your whole brain. Remember that compounding, that's not only in the charts, it's also outside the charts. If you're here for the easy and fast money, I said it before, I would recommend just stop. It's okay. You're just not going to join the Profitable Trader Club. I don't care. Go on YouTube, find your next dropshipping course. There are some very amazing ones, but trading is not going to be for you. Trading is hard work, the hardest way to the easiest money. If you survive the hardest path, you'll be fine. You'll be fine. If you're serious about this and actually want to give yourself a shot on making this in this amazing industry, give yourself at least 6 months. And I think I want to give a very big disclaimer here. Not 6 months of messing around. 6 months of focused, intentional grinding. Not like, oh, I bought a few challenges and I blew a few and I don't journal and I just take some trades here and there and I complain to everybody that trading is hard. No. It's focused, intentional improvement. Remember about the rate of learning? So you take a trade, you make a mistake, you're going to make multiple mistakes a week, maybe multiple mistakes a day. Make the feedback loop between you making a mistake and actually learning about it as quick as possible. Intentional improvement. Little life hack here. And it's also for trading, but in general, you cannot fail if you don't quit. So maybe for you, it's 6 months. Maybe for another person, it's 12 months. Hell yeah. I helped traders who were trading for 4 years. And they were doing like lots of work in it. But without intentional improvement, you can get 4, 5, 6 years in without making any money. There needs to be some intentional improvement. If you combine that never quit mentality with intentional improvement, I'm 100% confident that you're going to make it in trading. And why I'm 100% confident? It's what I did. I am my own proof. intentional improvement. I also had some months where I said I was trading, but I was not focused. Only when a mentor told me the frameworks I needed to know, the ones I'm teaching you here and also in the other teachings, that's where things start to click, the intentional improvement. Most people say, I'm trading for 4 years, but if you actually ask them, okay, give me 4 years of your journal, or give me proof of 4 years of you actually sacrificing everything you had to become successful in trading, they don't have that. So, and if it's you, all good, change today. 5, lack of strategy of edge. Trading is a business. The difference between the 95 losing and the winning 5% is very, very easy. The winners approach trading as a business, not as a cool side hustle. It's a business. That means revenue, expenses, and data. Your trading business, just like a regular business, needs data to perform. Why do you think data engineers and data scientists are the most in-demand job right now for big corporates? Because it's needed. So maybe start building data now, today. You have 2 choices right now. First one is the random approach. Spend 6 months taking random trades, hoping for the best, making mistakes, continue losing money due to your lack of data. Fine. It's a random approach. Of course, as scholars, so of course you're gonna know where I'm going to hint at right now. It's the second choice. Data and trust, so confidence building approach. Spend 6 months with a focused approach. So deposit between $100 or $1,000 in a broker, whatever you want to play with, in a broker account, and get to know every single data point of your routine, your execution, and journal everything. And yes, with the second approach, of course, we talked about this before. $100 or $1,000 is not the big money you hope to get when you start trading. But that comes after that. Remember? Hard at first, messy in the middle, gorge at the end. With the second approach, you can still make some nice extra income on the side, but the main focus here is data collection. And what do I mean by that? Everyone wants to achieve that 10K a month you see on when you scroll on TikTok or Instagram or whatever you want to scroll within a few months. But for almost all traders, that's not the correct approach. Because you need data. For example, you need to know your win rate. You need to know which risk to reward needs to suit that win rate. You want to know what your biggest losing streak is over a big data sample. You want to know your biggest winning streak. So for example, in this hypothetical scenario, you have a win rate of 40%. You're shooting 1 to 3s. Your biggest losing streak is 9. And you think, 9? Are you the worst trader? A 9 losing streak is. It's possible. Even when you shoot your edge. And your biggest winning streak is 5. A 5 winning streak, you can go to the back. That's crazy. Amazing. I love that. And this data, 40%, 1 to 3, 9 losing streak, 5 winning streak, is going to be your playing field. It provides feedback every single moment, indicating if you're still playing on the correct field. Okay, what does that mean? Determine your playing field. If you notice you're outside of your playing field, so that means in our example, having a bigger losing streak than 9, or your win rate is not 40, but it drops all the way to like 15%, it's time to start a feedback loop. Because then you know, okay, this was my data, this is how my trade should go. If I go outside my playing field, somewhere there, I'm like, hey, what do I need to do to come back into that baseline of your data? And the cool part is, if you're playing within your playing field, there's no need for insecurity, anger, being emotional when you have that inevitable losing streak. You know, it's simply part of your playing field. No panic. When you don't have data, remember the random approach, and you go in a 5 losing streak, I'm sure you will blow all your accounts you will, and you think, my strategy doesn't work, and everything is going against me. The market is taking me out, right? That's how it works. You'll probably switch strategies, go on YouTube, buy a new course, get a new mentor. You know, drill. I did that when I started out trading as well, years ago, so I know how you feel. But you have a playing field based on your data, right? Only if you lose more than 9 times, then it's time to review and reflect. And so when you lose more than 9 times, let's say you have a losing streak of 15, Then you can go to your journal. Like, hey, what went wrong? And most of the time, it's your first 4 or 5 trades, or your few trades, is just your edge hitting, and then you become more loose. Like you want to get that money back, you want to get a nice win in, and your psychology plays around. So then you have a perfect feedback loop. Now you know exactly where to focus on to improve. But the power of this playing field analogy is that there is no panic. You know exactly when you are still within your data, and you also know when you're stepping outside of your data and you need to actually improve something. So, from today, choose your team. The team on the left has data on their trading. It says 2 times left. No, team on the left has data on trading. Team on the right does not. You see that when you want to play this game, you want to score. I think it's easier to play from this side when you just can shoot the ball and just goes, because gravity goes to the other side. It's gonna be better. So on which side of the field do you rather play? I would say the one with data. But that's me. 6, lack of risk management. Removing your stalls. Guys, there's one guarantee to not make it in trading. And that is trading without or removing your stop loss. You can be the best analyst in the world, but one single trade can wipe you out. We don't have stop loss. You can be wrong. All your success in trading is on the other side of your ego. Another brain tattoo. Not in the slides, remember it. You can be wrong. Even when there's the best setup you've ever seen, all the stars align. It's a probability game, guys. Even when the trade is 99.99% stacked towards you, you still can lose it. So take the loss, put your stop loss in place, and see what happens. This means when you don't have a stop loss or remove your stop loss, this is your guarantee to failure and losing everything you invest in trading. So make it a non-negotiable. You should incorporate it from day one. Remember, we are going over the 7 traits of losing traders. Things you should avoid to become successful. I think this is one of the easiest ones. So if you cannot even commit to putting a stop loss in place, go drop shipping. Do it. If you want to do it, if you want to be successful here, stop loss. Nothing will save you, and you will not become a profitable and professional trader. I don't want to sugarcoat this. Like, if you want to lose money, remove your stop loss. If you want to make money, keep your stop loss. That's it. Most bad risk management, also that urge, like, oh, I need to move my stop loss to the like a little higher or lower, or I need to take profit already. Has their foundation in one single concept, and it's called cognitive dissonance. It's a mental disturbance people feel when they realize their cognitions and actions are inconsistent or contradictory. And what does that mean? It's an urge from your brain to fix your emotional imbalance. And this is present with your trading both when you're winning or losing. And how does it look like? That fixing that emotional imbalance. Let's say if you're winning, you're up, but then comes that cognitive dissonance, that emotional imbalance, that you might lose your paper profits. Oh no, I'm 1,000 in profit and my TP is at 2,000. I don't want to lose that $1,000. So you take off your trade way too early and miss out on that expected profit of 2K. That's cognitive dissonance in play when you are winning. Losing, same thing. You are down and you cannot stand the feeling of those red numbers, and the price can just consolidate in your drawdown. So without price hitting your stop loss, you already take the trade off way too early, while price still can go towards your profit point. Remember, you have a stop loss for a reason. That's the amount of points of money you are willing to lose on a certain trade. If you mess with taking off your trade in this scenario, you mess with your edge. Avoid it. If you notice you take your losing trades off so many times because you cannot stand this, then you have 2 choices. Or actually move that stop loss to point you normally take your trades off either way. let's say in a long scenario. Price goes down, you lose money. When price goes down and you take the trade off, let's say on 50% of your original stop loss level already. So let's say you have 1,000 risk on your trade, you take your trade off already at $500. That's not good, because when you press the button and put on your stop loss, you accepted the risk of 1,000. You just messed with your edge. If you want to fix this, well, you have two choices: or put your stop loss to that $500 risk mark, or reduce your lot size and do a bigger stop loss, because then the numbers are less when you're under it. Two choices. But again, cognitive dissonance. Be aware of that. And then the final one is the barrier of entry. Trading is hard. It can take multiple months to learn what you want to see in the chart. The time to learn trading is not paired to the specific trading language you learn. I think most people watching this are ICT traders, but like support resistance, supply and demand, everything works as long as you execute it consistently. It's all about changing your behavior and patterns based on the feedback you receive from the market. But make sure you focus on one of the trading languages. Like if you want to use indicators, Wyckoff, support resistance, go do it. That's completely fine. But focus on one and build data on that consistently. Don't strategy hop. Don't go from language to language. It is just not worth it. This means recording your trades, your thoughts, and your improvements. When you know, the expectation management here. When you know, you need to spend at least multiple months on getting your foundation trading right. The barrier of entry is not hard. You just don't know the best way to climb it. If I would start over trading, I'll give you the framework right now. If I would start over in trading, this is how my first 6 months would look like. And it can be with a low budget or with a more better budget. So for example, if you already have a job or you have some savings, you can invest in yourself in trading. Low budget is as follows. Your starting point. Find 3 courses. You can, of course, you found this one. Amazing. There are so many on YouTube as well. YouTube, whatever. Just find free trading course. You will find amazing ones. And of course, ICT traders. ICT's YouTube channel is full with amazing videos. It's a lot. That's why, of course, you find a mentor to help you. But it's online. That goes free course that goes over different aspects of trading, not only charting. If you find a mentor or someone who teaches you who can only talk about technicals, big red flag, guys. Big red flag. Technicals is only 20 to 30% from whole trading. The rest is, I'm going to show you in a second, is the rest of the trader pyramid. In the first month, get to know the basics in trading, like candlesticks, market structure, trading view. This is all if you're new. In this school group, there is a section called Beginner Bootcamp. I will teach you in like 9 short, simple teachings, everything you need to know if you're a beginner. So if I would start over, I would watch the Beginner Bootcamp. Month 2, finding your entry model. And that means, what do you need to see happening in the chart before you press the buy or sell button? I will give you an entry model for free later. Month 3, building data on this entry model. So that means executing it on the chart in real time, but also backtesting it. So you're already 3 months in. You know the basics, you know how trading view works, you know a simple entry model. It doesn't need to be very complicated. Just X, Y, Z needs to happen, then I press the buy or sell button. Then month 3, you build data on that. What's your win rate, losing streak, win streak, risk to reward, like the data points. Month 4 and 5 are boring. Why? You have your entry model, you know your data, your playing field. Now it's just time to sit, wait for your setup to appear, and execute consistently. You'll find things you can improve in your model to increase your likelihood of more winners. So you're going to refine and enhance your entry model over time. It's very boring. No shiny objects. It's very fucking boring. Month 6, you have your data from month 4 and 5, where you actually enhance your strategy multiple times. You have a refined strategy, a better strategy. Know based on data what you want to see in the charts before you press the button and what you can expect as an outcome of the result of this. So if I do X, Y, Z in the charts, I can expect this amount of trades to be winners, this amount of money I can make. It can be a range. And based on that, you can actually build your business. You can actually start scaling your trading accounts with or without leverage. And from month 6 and forward, it's just scaling. And then if you have a better budget, this is how my path looks like. I found a mentor. Find a mentor who's a few steps ahead of you. Like if you're starting around, you don't want a mentor who makes 100 million per month or per year or whatever, because there's too big of a gap. I have multiple mentors on my way where I'm in right now. So my first mentor was one who was a few steps ahead of me, who learned me the basics, who learned me the framework I'm teaching you right now, and expect them to be around 500 to 2K. And of course, the mentors become more expensive the more experienced you become. But of course, it's very nice because you make more money, you can invest more, and you compound yourself. A mentor shows you where you need to focus on in this overwhelming stage of too much information. Like at the start, if you, let's say, on YouTube search beginner trader course, you will find 500 different courses, all 10 hours long, every single one amazing in their own thing, but you don't have the context yet of which concept of this course can I pair on this one, and there's just too much information. There's where a mentor comes in who says, yo, focus on this and this, combine that, go to the chart. That's what my mentor did, and what I know other traders had the same experience. Month 1, exactly the same. Beginner bootcamp. Find some, I created one, but you can also find on YouTube. Get to know the basic in trading. It's in the classroom section in the school group, and also on the YouTube channel on DionTrades. Month 2, ask your mentor what his entry model is, and use his one or her one as the foundation of your own entry model. So don't copy your mentor's model. That's a huge mistake. Why? It's not yours. You need your own entry model. What suits your personality, what you like to see in the chart. But if you already have like a foundation of a mentor or a trader you admire, you can use it as like a framework, as a basic, and see like, okay, what I see him doing in the charts, I like that, but I don't like that one. Maybe I can change X, Y, and Z, and you can make it your own, and then build data on that. If your mentor's model works already, the only thing you need to do is tweaking it to your own trading style. And because you already have like a basic, like a foundation, it will save you a lot of time. Month 3, building data on this entry model, backtest and journal. And then month 4 and 5 is the boring part, but now you have a mentor. So you have data, execute on the data consistently. Because you have a mentor, you can sit down with your mentor and ask him or her what you can improve on your current trading model. So you go to your mentor, you say, hey, here's where my 3, or let's say 1 or 2 months of data look like. I see I'm executing here very nice. I see that I'm struggling with X, Y, and Z. What can I do best to fix this? Remember about the intentional improvement, about the rate of learning, the time between you making a mistake and you learning from it, change your behavior to not make the mistake again. Your mentor is going to be that shortcut. Your mentor will just say, hey, try this and this. This will help a lot. And probably it will, because your mentor had exactly the same struggle when he was in your shoes. And next to the lines of your mentor, you will also find things you can improve in your model yourself to increase the likelihood of more winners. Month 6, following these steps, you probably already made a small amount of money. You can now reinvest that in more expensive mentors who can bring you from the beginner stage towards the more advanced stage. This is exactly what I did, guys. Of course, you pay more money for better mentors, but you have a foundation for your first mentor. You already made some money, or if you're not making money, also fine, but you create already an insane foundation. You need to then scale with a mentor on a higher level. There are multiple mentors who can do everything. They can teach you the basics, teach you more intermediate stuff, and just the advanced scaling stuff, because this is what I did. So that's, yeah, I would recommend going for this route. If you don't have any budget right now to do it, go to the low budget route, and when you have money, make this shortcut for a mentor. I have a mantra or a brain tattoo is don't invest in courses, invest in mentors. I'm not going to explain this. Think about it. All right, cool. With both the low budget and the better budget, you're doing the one single most important thing. And that's building data, building your business. On top of this, when in the future, this may be like a little point on the horizon. Like, what do you want to do with trading? Do you want to sit in Dubai, sitting on a jet ski all day? Fine. Some traders want to actually grow in their trading, and the end game for traders is a fund, is a hedge fund, or maybe a bigger fund or trust or whatever. If you want to work there, the first thing, if you want to trade for a multi-million-dollar hedge fund, the first thing they're going to ask for when you want to apply there is, yo, fine, I like the way you look, I like the way you talk, show me your data. If you don't have data, they'll say, okay, fine, how do we know you are a good trader? And they say, yeah, I do this, I'm funded. No. You need data, actually hard data. So if you have the aspiration to trade with bigger money, not prop firm money, like tens, hundreds of millions of dollars, use that motivation to start journaling and building data. And the cool part is, if you build data from day one, or this is your day one, even if you're trading but you're not journaling, this is your day one, you journal right now, you can show you actually improvement over time. Start as early as possible to get the fastest results. Boom! You now know the 7 traits of unsuccessful traders. And I think that's the reason for a nice little confetti there. You know now what to avoid. But now you need to know where to focus on. But what is the actual framework you need to follow to become successful? What to do? I created a framework that teaches exactly this, and that's called the Trader Pyramid. And this is what it looks like. It's a pyramid, and your foundation is here, and on the foundation you build different layers. First one is your psychology, your mental game. On top of that, there needs to be a trade plan. On top of that, you need to build data on the trade plan. And only on the top, there is your technicals. Remember earlier when I mentioned that technicals, like the cool trading courses where you need to watch this and this, that's only like 20 or 30% from what trading is. Actual professional trading is more about layer 4, 3, and 2. Journaling, trade plan, psychology. Because you can trade support and resistance, you can play supply and demand, you can trade Wyckoff, or whatever indicator you want. If the foundation of the layers below that are not good or non-existent, I know many traders who come to me and I ask, show me your data. They don't have data. So they're actually having a trader pyramid which misses a full layer or don't have a trade plan. And they're like, oh, well, all my trades are profitable. Right? 4 layers. Let's go over them one by one. First one, psychology. This is the bottom, foundational layer. It's your mental game. And this consists of like all that stuff that you're struggling with mentally. Remember your reptile brain and your limbic system, FOMO, overtrading, revenge trading, self-doubt, overconfidence, fear, greed, discipline, patience, losing, resilience. Trading psychology is one of the most interesting things there is, because trading goes against everything you want in your brain. It gives you lots of cognitive dissonance, your emotional imbalance. And I think most of you here are like the adrenaline, the rush. So that's going to be the biggest focus point, and it's amazing. The only way you can fix this is having strategies and routines in place to deal with them. In the next teaching, when we go over the first layer, the psychology layer, I will go more in depth on this. Then on top of that layer, the psychology layer, we have the trade plan layer. What do you need to have in your trade plan? You need to have your goals. You know what markets to trade, which pairs. Do you trade gold, Bitcoin? Do you trade options, stocks, Forex, whatever? Market selection. You need to have a strategy. What do you want to see in the chart? You need to have risk management in place. And also you need to have a trading schedule. Then, on top of that, so psychology, trade plan, journaling, building data. You need to build data on your trading ASAP. And you can do it in 2 ways. Looking at past performance, backtesting, looking at price in real time, and journal that. Tools to use for backtesting can be TradingView or a TradingView with a replay button or FX replay. You can use for journaling, you can use Edgewonk, you can use Notion, whatever you prefer. Just do it. And on top of the trade pyramid, the smallest portion actually is the technicals. What do you want to see the charts before you press the button? It does not matter with trading, which language you speak. Doesn't matter. Just choose one and stick to it for at least 6 months while you're building your data. This is what support and resistance looks like. This is what supply and demand looks like. This is what ICT looks like. I trade ICT, and in the specific teaching on technicals, we're going to dive deeper into it. I want to congratulate you. Amazing. You stuck to the end. You took notes. Hopefully, you learned something. There are some paradigm shifts maybe you already had, but this is the foundation you need. You now know the 7 traits of unsuccessful trading. You know how the trading pyramid looks like, and in the next teachings, we are going over every single layer in detail. So at the end of this market mastery course, you have everything. You have every single foundation you need to make money with trading. Let's go. You just finished the first part of this video, and you may need some extra help with trading to get funded, consistent, payouts, profitable, all that stuff. If that's the case, check out the link in the description to see what the best next steps are for you and how I can help you the best. Links in the description. Now let's get back to the video. First, we're going to talk about the trader pyramid. You guys know this. Foundation of psychology, trade plan, journaling, and technicals. In this teaching, we're going to talk about the foundational layer, psychology. It's the foundational layer. It's your mental game. It consists of FOMO, overtrading, revenge trading, self-doubt, overconfidence, fear, greed, discipline, patience, but of course impatience, losing, and your resilience. And for all these things, you need to have both strategies and routines in place to deal with them. But first, you need to understand what your brain actually does to work against you. In the previous teaching, we already went over the basics of your brain, and now we're going a little deeper. On the right side, you see your brain. You have your reptile brain, your instinct survival, so your fight or flight. You have your limbic system, your emotions, and the third layer is your neocortex, your rational brain, speak, logic, and higher thinking. Trading triggers your reptile brain, your fight and flight, and also it triggers your limbic system, your emotions. But those are the ones who are working against you. Your trading should be made, your decisions should be made at the neocortex level, your logical higher thinking. So while you're trading, every single day, you will see a battle between all your layers. You will actually notice it's working inside your brain. The losing 95% of traders are stuck in their reptile or the limbic system. The winning 5%, that is you, are going to focus on how to spend the majority of your time in the neocortex layer of your brain. Let's talk about fight or flight. That's the one in your reptile brain. In high pressure situations, like trading, our brain activates your fight or flight mechanism, which is just a basic survival instinct. This response often leads to emotional rather than rational decision making. And this might cause you, I think you recognize this, you to panic exit during drawdowns, or impulsively enter trades to chase the market, or take your trades off earlier. You take aggressive partial with no reason. That's just your fight or flight instinct doing the work. There's also 3 biases you need to be aware of. First one is your recency bias. It's a tendency to weigh your recent events more heavily than long-term data. If you are in a 3 or 4 losing streak, you will notice that your brain is going to trick you in saying to yourself, like, maybe I shouldn't take this trade because I lost the previous 3 or 4 trades already. Maybe I shouldn't do it. But all the data, if you had data, long-term data, states you should take the trade. That's why you need to start building data from the start. And we'll talk about that later in this course. The second bias is the confirmation bias. Seeking information that confirms pre-existing beliefs while ignoring contradictory evidence. It's your tunnel vision. You take a trade, you have a bullish bias, you want price to go up, and you just only think bullish, bullish, bullish. But there's more. Maybe the market already said to you very obviously, we're not going higher yet. We're first going lower. Maybe your retracement or some liquidity sweep, whatever. But if you're aware of your confirmation bias, it will reduce the time you spend your tunnel vision. The market can clearly tell you if price wants to go higher or lower, and you should be aware of that. The third thing is loss aversion. Avoiding losses at the expense of potential gains. This is your brain tricking you to take your trade off early while you are in drawdown. Be aware of this. Your brain works against you. Emotional responses are natural, so don't try to, like, on Twitter, Instagram, TikTok, you will see the reels, you will see the content that says you should trade like a robot. Personally, in my opinion, I think that is not true. Because you are human, you have emotions, but you need to be able to deal with those emotions. Emotion responses are natural. Remember your limbic system? It's there. You cannot turn it off. It would be nice, but you cannot do it. It must be managed to avoid impulsive trading or just making stupid decisions. The goal here is not to remove them, but to recognize them early and stick to a predefined plan when they happen. So the first thing is very easy. It's awareness. Hey, I'm now noticing that I'm very scared to trade. Hey, I took a few wins in a row. I notice I'm greedy. I want to double my TP because I am awesome and I take an amazing trade. Be aware of this. And that leads to the next brain tattoo. With better daily awareness, you can make better daily choices. And with better daily choices, you will start seeing better daily results. But it all starts with awareness. So the moment you're aware of a problem you have the ability to make a better choice, a choice that gives you the 1% improvement that compounds over time. And with better daily choices, you'll start seeing better daily results. Better daily results will lead to better weeks, better quarters, better years. And all of a sudden, you are way ahead than yourself from earlier. Recognizing mental traps. The most common four are overtrading, FOMO, revenge trading, and ego and overconfidence. Overtrading is trading excessively due to boredom, greed, or the compulsion to recover losses quickly. So you have multiple layers of overtrading. Most people who are very excited and passionate about trading, they will find boredom trading one of their biggest issues. Personally, that was my biggest issue starting out with trading as well. I loved it. I was on the charts every session, 10, 12 hours a day. But I was just bored and I wanted to press the button. Not a very nice characteristic to have. Also greed, or the compulsion to recover losses quickly. Don't do it. FOMO, fear of missing out. The anxiety feeling of missing out on potential profits. I should have been in that trade. Leading to you chasing the market and leading to impulsive trades, messing up with your risk to reward, and you're probably taking more losses than you should. Third is revenge trading. Attempting to recoup losses quickly by making high risk trades, doubling your lot size, reducing your stop loss by 80%, shooting 10 trades in a row just to try to get that loss back. I think revenge trading is one of the easiest and quickest way to lose all of your money. Ego and overconfidence. Remember, successful trading is on the other side of your ego. So true. Letting ego drive decisions, often leading to underestimating risk, or the most dangerous one, overestimating your skills. If you are on a 5-win streak, you are on top of the world. You tell everybody you know like how an amazing trader you are. You are ready to rake in millions. Until your ego is going to stop you. Because you're going to take a loss somewhere. And then you are like, no, I cannot take a loss. I'm the best trader in the world. That ego will lead to overtrading, revenge trading, and the whole cycle starts again and again. It's your ego. Let's now dive into all the 4 pitfalls one by one. Let's go over some strategies you can use to avoid overtrading. First of all, set clear limits. That means establish daily or weekly limits on the number of trades you take. You just have, let's say you have a gun and you have certain bullets to shoot. Let's say you want to take 8 trades a week. That means for the week, you have 8 bullets to shoot at the market. If your 8 bullets are shot, you have an empty gun. You cannot shoot them anymore. Those are your limits. Stick to a predefined maximum risk per trade. And the second strategy you should incorporate is quality over quantity. You have a gun, not a machine gun. Like you have like a pistol with like a certain amount of bullets in it. You don't have like that Rambo kind of style where you can just shoot everybody. No. It's quality over quantity. You have nice silver bullets. Focusing on the quality of trades, ensuring they meet all your strategy criteria. And avoid trading for the sake of activity. That's for most traders. That's the boredom trading. You just like the market, like, let's do it. And it also feels like your casino gamble. You just want to play some hands, play a card. Trading doesn't work like that. High probability setups only. For new traders, this is a very important one. Scheduled breaks. Because you are in a weird situation. Well, because you know from school and from your previous education that you know, and I think most businesses work like this, the more you put in, the more you put out. Trading doesn't work like that. The more time you spend on the charts, the less your results will be. That's counterintuitive. But trust me, taking regular breaks to avoid fatigue and maintain mental clarity is key. Use downtime for analysis and strategy refinement rather than compulsive trading. And maybe you're like, yeah, but I need to learn so much about trading. I don't want to take breaks. And honestly, I applaud you for that. That's amazing. And there's a difference between taking a break and be lazy and go watch Netflix or whatever, go to a party, or take a break from the charts to then go read a book, watch an occasional video, analyze your journal. But actual chart time where you are trying to hunt for a setup on the charts, that's the time you should minimize, because the more you do it, the less results you will get. Fourth one is awareness, where we talked about this before. Be aware of your emotional triggers that lead to overtrading. Reflect on past overtrading incidents to understand and mitigate triggers. Remember, build data on your trading. That also means recording how you feel and labeling your trade like, hey, this was a loss. Not based on my edge, but I was just overtrading. I was bored or I was greedy. If you have that data, that's amazing, because then you can reverse engineer what actually made you overtrade. So you can start that feedback loop. Remember, you want to learn. Learn is getting feedback on a mistake and changing your behavior to not make that mistake again. That's what you do right here. Second one, FOMO. This one is most obvious when there's big news reports coming out, like inflation, like CPI, FOMC, like the rate cuts, or NFP, like the big green or red candles. FOMO is a real thing there. FOMO is the anxiety feeling the opportunity is being missed, often leading to impulsive decisions. And you will see this in chasing trades, entering them late, and because of that, taking way unplanned risks. And what is a strategy you can implement to combat this? The first one is long-term thinking. Because when you are having FOMO, you're like, okay, I just missed this trade. This was the last trade I could ever take. After this trade, there is no opportunity anymore. Never. That's what your reptile brain is thinking. Because that's why you're having FOMO. But if you think long-term and you know that, okay, I'm going to trade for at least 5 years. Or at least, let's say 1 year. Coming 12 months, I'm going to trade. You really think in the coming 12 months, there won't be any amazing opportunities coming. Think long-term. Think longer than this session. Doesn't make any sense, right? So if you notice FOMO, think about, hey, in 12 months, am I going to take another trade? It could be similar to this. The answer is yes. Stop it. Don't chase that trade. Second one is discipline. Stick to your trade plan and resist the urge to deviate. In your trade plan, we're going to talk about in a later teaching, there is no chase trades section in your trade plan, because that's something you should not do. It's pure discipline. Are you the trader that's going to chase trades? Are you the trader that's going to create a trade plan and follow it? If yes, you don't do this. It's an identity level of your personality. And diversification. Spread risk across different assets to reduce the impact of missing out on a simple opportunity. It simply means having multiple pairs on your watch list. So for example, you have, let's say you trade Forex and you have Euro US dollar, you have USD CAD, and you have CAD JPY on your watch list. If one of the three goes and you're feeling that FOMO feeling, maybe on the other two you had on your watch list, you can still get a nice entry on those. Because the one that left without you, the FOMO one, you're done. Like, that is just not an opportunity anymore. So use these three strategies to help you out when you notice you are having FOMO. And the third one, revenge trading. Recovering from losses without overreacting. First strategy. Sounds horrible, but you need to accept it. Accept that you fucked up there. And reflect. Accept that losses are part of trading and take time to reflect on what went wrong. Create that feedback loop. Avoid the urge to immediately recover losses with new trades. If you have that feeling, like you took a loss and it's probably a loss that you knew you shouldn't take in the first place. That's the most dangerous one, because then you will actually want to come back to it very soon. Instead of using your time on shooting your full gun, just empty with all your bullets in one session, use that time, use that energy. It's of course a kind of energy, it's an emotion. You want to use that emotion, you want to use that energy. Use that on getting new data to use for your next trade. Reflect. Go to your journal. Go put it in. Why did you do it? What do you need to do exactly? Which steps do you need to take to avoid it next time? Use it as an action point to the next day or the next session. If you had a session where you were revenge trading, there is a mandatory cooling off period. Implement a mandatory break after a significant loss to prevent that revenge trading. That should be in your game plan, in your trade plan. For me personally, when I have a session where I know, hey, this second trade was a revenge trade, I shouldn't do it. I'm a little emotional on a higher level and another good level. For me, it's at least one session. If it's a bigger loss than usual, I even say like 1 day or maybe 2 days. Cooling off period, and then you have fresh mental game. And in the cooling off period, I'm just going to reflect. I'm not going to just chill and watch Netflix. I'm going to actually intentionally improve. And there needs to be recovery goals. Plan for a gradual recovery rather than aiming to recoup the losses in a few trades. Maintain discipline, stick to your risk management rules during that recovery process. And this is the boring part, that gradual recovery. If you, let's say, usually you risk $100 per trade, and with your revenge trading you lost $1,000. It takes a long time to recover from $1,000 loss, which is those small steps. So that means it's the boring part, but you need to go through it. Out of the drawdown. Small steps done consistently over time yield staggering results, right? You remember that from the previous teaching. That is your recovery plan. And the fourth one, managing ego and overconfidence. First of all, the self-awareness. You need to know, first of all, how your ego is. For most people trading, I'm gonna stereotype this, I know, but most traders are people who don't want to work a 9 to 5. They won't want a boss. They're stubborn as hell. Nobody can say what to do. So I would say traders in general have kind of a big ego, me included. That means if you are aware of this, you can fix it, or at least help yourself, not letting your ego stand in your way. Regularly assess your attitude towards trading and success. What's trading look for you? What do you want to achieve with trading? And is your behavior aligned with those attitudes? Be aware of signs of overconfidence, such as dismissing risk or ignoring market signals. So you will notice after, let's say, a few wins, that you're going to be looser with your trades. You're going to shoot B setups. You're like, I made so much profit. I'm just going to use a small percentage of my profit on my B setup and see what happens. That's the first key, like, hey, maybe I should not do this. And maybe I should wait, because now my ego is just on the charts and not me. Also, continuous learning. The difficult part with a big ego is you know it all. So you don't need to learn anything. I have my model. I'm good now. I can make millions. No. You are a student of the market. Stay humble and open to learning new strategies and market insights. Regularly seek feedback and engage in educational activities like reading a book, watching a course, like you're doing right now. Amazing. Do this. It will help you stay humble. Diversify risk. Avoid putting too much capital into a single trade due to overconfidence in its outcome. Remember, even if the trade is 99% stacked towards you, you still have that 1% who can wipe you out. Don't be overconfident. You can also diversify over different trading accounts instead of only different pairs or different trades. And also what helps a lot with this is having peers and mentors and an ecosystem in general. So I would recommend finding an accountability partner who is around at the same level. With my inner circle, my private mentorship, this is actually the first thing we do is, of course, I'm on your mentor level, but there needs to be some peer, someone around the same level you can talk to, you can share stuff with, trades or maybe outside the charts, but someone who understands you because they're on around the same level as you, and you can grow together. Amazing tip. So if you have some close friends who you can ask, do it, and just share trades with them. Like, hey, what do you think? It will help you with your ego and overconfidence. Same with your mentor. And use their insights to gain perspective on your trading behavior and decisions. And a good accountability partner or a good mentor will say to you, let's say you take in 5 trades where 4 were like horrible, not good. A good accountability partner says 2 things. 1, what the hell? Fix your shit. You're doing this completely unacceptable behavior. Secondly, they say, what are you going to do right now to fix this? And how can I help you with this? Because we're doing it together. This is unacceptable. It's just, well, there needs to be really strict for you. This is good. No sugarcoating. A bad accountability partner says to you, oh, that is a shame. Oh, but you will be fine. You'll be fine. Pat him on the back like your mom with her cookies. No. Accountability partner is accountability. You fucked up. Fix this. That's nice. Little scary accountability partner harms no one. Having routines in place is the first of 2 steps. The second step is following your routine. So now we went over the 4 most common issues with your psychology, and you now have some tips to work for. Like the awareness and the routines you can have, like for example, with FOMO, and that's one. But the second, and maybe the most important one, is following those routines. You can make the most incredible sheets, documents with, hey, if X happens, then I do Y or Z. But if you're not able to follow it, it's worthless. That's the second step. It's discipline. What is needed to follow your routine is discipline. And let's go over a quote from Alex Hormozy. People with self-discipline don't have more willpower. They're no superheroes. They figure out how to alter their environment ahead of time to make it easier for them later. So it's not about resisting the cookies right now. It's about removing them from out of sight 2 days ago. And the same should happen for your trading. The cookies, in this case, can be FOMO trading, over trading, whatever issue you have in your psychology. They need to be removed from the house 2 days ago. And there your triggers come in. You should be very strict with yourself and research yourself, like investigate yourself. What triggers me to do stupid stuff on the chart? Personally, for me, that is when I'm tired, when I've traveled, or when I have a long content day. When I go to the chart, I know my mental game is weaker because I'm just exhausted. Then I know I'm probably not going to press the button. I'm not trading it. That is me removing that cookie, that weak mental game from my house way before it happens. I know I'm not going to trade. And that's only because you need to build data on this. So routines are your software. Software, just like you have on your computer, on your mobile phone, is a good software makes a phone or a device very high quality. And you need some high quality software in your brain as well. And the cool part is, the more you train your software, the easier your routines become. So let's go over this framework. The easier routine, capital you need to use, your brain in your battery in your head. If you have more daily mental capital, you have better daily discipline because you're rested, your battery is still full. With better discipline, you have more patience. More patience means better executions. Better executions is more wins. More wins is a more happy trader because you make money. That's the whole reason why you're here. Make your routines as easy as possible, and they're personal. What works for me doesn't work for you, and vice versa. Make it you. Talk to your mentor about this, talk to your accountability partner about this. The less mental capital you need to use, the happier you will become. And I think everybody wants to be a happy trader, chill, happy trader, makes money. Of course, you take losses, but those losses shouldn't weigh a lot of you emotionally. It all starts with your routine. The mental framework that fixed 90% of my mental issues in trading is the Stoic approach. Stoic approach is focusing on what you can control. In Stoic philosophy, focusing on what you can control is a key principle that involves dividing the world into things that are under your control and things that are not. Stoics believe that you should focus on the things you can control and detach yourself from the things you can't. So if you apply the Stoic framework on trading, let's go first on the red side. What is out of your control? If you win or lose, you cannot predict the candles. When big volatility injections mess with your trade, so the massive wicks, they're like, whoa, where did this came from? It just wicked me out before going to my TP. No control over it. Broker issues, prop firm issues, brokers go down, profits go down, out of your control. Maybe if you choose a shady prop firm or broker, it is on you. But in general, if you choose a high probability or a high quality broker or prop firm, it's out of your control. There are issues there. So your energy should not be focused there. It should be completely removed from there. And this Stoic approach is in everything in life. Only put your energy in things you can control. What can you control in trading? When you press the button. What stop loss you use. What take profit level you use. Your risk management, your lot size, your risk to reward. And your emotional discipline. Nobody in a certain moment is forcing you to press the button. Nobody. It's only you. You control that. Which is amazing, right? Focus on these things you can control, and you will notice your energy shifting from a basically loser to a winner. Losers focus on things they cannot control. The news, the government, the boogeyman. Winners focusing on building, focusing on growing. Everything is in their control. Join the group. Join the winner group. And let's also take a look at how one of the best traders in the world deal with their emotions. Meet Paul Tudor Jones. This is him. And Paul Tudor Jones, to give you a little background, is one of the most successful hedge fund managers, famously predicted and profited from the 87 stock market crash. And despite his long-term success, Jones has spoken openly how critical emotional control is in trading. Because you only hear the background or the headline, like, oh, this is an amazing trader, but he openly speaks about the mental issues in trading. And he mainly focused on fear and overconfidence. Early in his career, Jones faced the fear of significant losses, especially after a string of losing trades. He does this as well. Even the best traders have this. He recognized that fear could paralyze him or force him to make irrational decisions. Remember, your brain, your reptile brain, your limbic system, if you are losing, this is what happens. It paralyzes you. Or you make irrational decisions. You're not having your neocortex working for you. And also overconfidence, the other side. Jones noted that periods of success led to overconfidence, where he risked more capital than he should, forgetting that the market could turn against him at any moment. This is very recognizable, right? You have this as well. So maybe your problems and the problems on the best trader in the world aren't that far apart. And it also means the opportunity for you to become one of the best traders in the world is also not that far apart. And what he did to fix this: strict risk management and emotional detachment, not trading like a robot. To counteract these emotional challenges, Jones developed a strict management strategy where he would never risk more than 1 or 2% of his capital on one single trade. If you have this, it's very easy. Remember, the easier the routine, the happier trader, that whole framework. He just knows, okay, when I shoot a bullet, 1% or 2%. That's it. This helps reduce the emotional impact of any individual loss. And the second one, emotional detachment. Jones would often mentally rehearse losing trades to prepare himself emotionally. It's amazing, right? He just visualized in his head, okay, if price, I'm now closing my eyes, if price comes against me right now, how would I feel? If price goes towards my TP, how would I feel? You're mentally rehearsing how you would emotionally respond to winning or losing. And especially if you are going through a losing streak, I would definitely recommend trying this. This allowed Paul to stay calm when a real loss occurred, as he had already conditioned himself to expect them. The most important rule of trading is to play great defense, not great offense. You have to be willing to take losses as part of the game and protect yourself from emotional highs and lows. One of his most famous quotes. So to break it down a little bit further, great defense, not great offense. Because you play great defense, you're playing capital preservement. You are not going for that big wins, but you're preventing those big losses. Your wins will stack over time. Small things, seemingly insignificant things done consistently over time yield the greatest results. So play defense. That doesn't mean don't take losses. There's a huge difference here. Don't get me wrong here. You should take losses. But it's about those massive losses you take when you fucked up mentally. When you're revenge trading, removing your stop loss. That's the defense. That's your wall, your non-negotiable wall. Go lose. It's amazing. You should train yourself to lose. But it's all about the great defense is about those big losses that wipes out weeks and maybe months of hard work. You have to be willing to take losses as part of the game. So your tuition money to get information on the market. And I think this is also a very powerful one. Protect yourself from emotional highs and lows. Most people who trade are degenerate gamblers. They fucked up in the casino, and trading is exactly the same emotions. But you shouldn't go for the rush, your adrenaline push. Make it as easy, as business-like as possible. You see X, Y, Z happening in the charts. Does this align with your trade plan? Do you feel mentally rested? Are you ready to push the button? If the lights are all green, push the button. So thank you, Paul Tudor Jones, for this amazing insight. A recommended read for more of these kind of case studies is a book called Market Wizards: Interview with Top Traders. I think a book in general is the biggest investment in yourself you can do. Like $20, you can gain insights in the brains, the minds of the greatest people in the world. So definitely recommend picking this up. No affiliate links, nothing, just me sharing a really good book. And you can thank me later. So now we discuss the first layer, the foundational layer of the trader pyramid. We already went over the psychology level of the trader pyramid, and now we're going to build on that foundation with the trade plan layer. And the question you should ask yourself is, why do so many traders fail? And it's because this is all random, what they do. The answer is very simple. Losing traders have a lack of structure. Losing traders tend to do emotional trading, and losing traders have inconsistent strategies. Your trade plan serves as a roadmap that removes emotion and increases discipline. All professional traders I know use a trade plan. So I guess that's some common denominator you could take away from this. Like, maybe you should have one as well. You need to have criteria in place before you decide to press the button in the chart. That's your trade plan. And it consists of 5 parts. Your trading goals and objective. Where are you trading towards? Which assets are you trading? Your trading strategy, your risk management, and your trading schedule, combining it with your real life. The first one, setting goals and use data to work towards your goals. The key to success is focusing on consistent small gains rather than hitting big risky trades. Aim for consistent performance, not perfection. You're gonna lose, you're gonna make mistakes, you need to be consistent. Even professional traders don't win every trade. I lose as well, it's all part of it. At the end of the week, at the end of the month, the end of the quarter, the end of the year, you should be consistently executing your trade plan, and if it goes well, make money. And remember, the Stoic approach, only focusing on what you can control. So instead of saying, I'm going to make 400% profit this year, the goal should be, I'm going to stick to a trading plan and rules, And based on the data collected on this trade plan, I can expect a result that is around the range of 3 to 400%. But it can deviate based on factors that are outside of my control. Remember, you don't have control over what the market does. You just have your edge, you execute it consistently, that should be your goal. The money comes after. Tracking progress regularly and use a journal. Record every trade, win, losses, emotions, setups, and regularly reviewing this data will help you spot patterns and improve over time. It's all about intentional improvement. And that's the question, how to measure improvement. Track not just profits, but also how well you're sticking to your trade plan. For example, did you follow your rules, manage your risk properly, or your emotional trading? That is how you can measure your improvement, not the money. It's more than that. And you need to understand what success looks like. Success is discipline. Success in trading doesn't always mean more wins than losses. It means executing your plan consistently and managing your risk efficiently. And don't forget, you need to celebrate the small wins. If you've avoided overtrading, for example, followed your trade rules, and maintained emotional discipline, that's a huge win. A huge win. Even if you have a losing, even if you at the end of the month had a losing month, that's not the problem. It's an amazing thing that you avoided overtrading, followed your trade plan, and had emotional discipline, because that will help you in the long run. So instead of focusing on the quick profits that 95% of traders do, prioritize consistency and execution of your trade plan, and then see what happens, if there's money following or not. Then improve on that over time. Profits will follow as a result of your discipline and your refinement. That's the first part. Check. Let's go to the next one, market selection. Focus on your strengths. Select markets that you are knowledgeable about or interested in, such as Forex, stocks, community, crypto, and every asset is different. Every asset trades different. For Forex, currency pairs often with high liquidity. Stocks are shares of company, more for long-term investing. You can trade stocks as well. Commodities, like gold, oil, and crypto, Bitcoin, Ethereum, Solana, meme coins, we're going to talk about in a second. It does not matter which one you pick, as long as it suits your personality and interests, and you stick for it for at least 6 months. Don't hop on this. Like, if you want to trade Forex, trade Forex. Don't trade Forex on Monday and you tried it 4 days, and then on Friday you're like, nah, I'm going to do crypto. And then on next Wednesday, you're trading stocks. No, stick to it, because you need to build data. On top of that, focus on certain volatility levels that matches your trading style. High volatility, more suitable for day traders and scalpers. Low volatility is better for swing and long-term investors. Choose markets with sufficient trading volume to ensure smooth entry and exit. And what I mean by that is major currency pairs like Euro US dollar or high cap stocks like Nvidia often have high liquidity. So easy exit, easy entry. If you do your random low market cap meme coin in crypto, it's not going to have much liquidity, making it harder to exit. And if you make profit, you want to exit it. And if it's hard, it's not a good thing. So keep in mind, volatility and liquidity. That's the second one. So you need to have your goals, and you need to know what assets you're going to trade. Third one is your strategy. And I want to give you a questionnaire. And you don't need to answer this on this teaching, but it needs to be part of your trade plan. These questions should at least be answered in this section of your trade plan. First, what do you exactly want to see in the market before you press the button? When you press the button, where's your stop loss most likely going to be? And when you're in a trade, where's your take profit point most likely? Also, what needs to happen before you take your trade off? Or don't you take your trade off at all? It's up to you. Do you take partials? If yes, where or when? How much percentage or risk in dollar amounts do you shoot per trade? And when you execute this strategy, what win rate can you expect? And this data you can find while backtesting and also later when journaling. But look at how many questions you already should ask yourself on this trading strategy. If you cannot answer one of these questions very precisely, there's work to do. Make sure you can answer this. And why? It breeds clarity. When you exactly know what to do, it's easier to follow. Remember, the easier routine, the easier it is to maintain discipline. Answer these questions. And there's one more question. Does the strategy you are using align with the type of trader you are? So if you look at this little picture here, what type of trader are you? You have, let's say, 3 flavors: scalper, day trader, swing trader. And if you are more the scalper kind of trader, you have not much free time, but this higher stressful environment, you're on the lower time frames, high risk, high reward. Or you can be a day trader with average free time, more than a scalper, less stress than a scalper, lesser risk than a scalper, but less reward because of that. Then you're a day trader. Swing trader, lots of free time, just on a higher time frame, shooting trades, low stress, low risk, low reward. It doesn't matter which type you are, but it needs to align with the strategy you're using. So for example, if you're a swing trader and your strategy is focused on quick movements on a 1-minute time frame, that's not correct. Your strategy does not align with the type of trader. If you are a scalper and you're on the 1 minute, perfect. That's good. Then it's aligned, but it needs to align. So that is your third part, your trading strategy. Fourth one is your risk management. And I think that's the most important part of your trade plan. Effective risk management helps safeguard your trading capital against significant losses. Like, you can have the most fancy stuff in the world, but if your risk management is poor, you're not going to make it. By managing risk, you can maintain your trading account over the long term and improve the potential for profitable trading. Messing up your risk management is your guaranteed single road to failure, guys. You can have the coolest strategy, but when you blow your bankroll, because bad risk management, it is worthless. Also, set a risk percentage per trade and set stops. Decide how much of your account you're willing to risk on a single trade. Typically, let's say between 1 or 2%. An example, if your account balance is 10,000 and you risk 1%, that means the maximum risk, or the maximum amount of money you can lose per trade is 1% of 10K, is $100. Also, use stop loss and take profit orders. If you don't know what the stop loss is, it automatically exits your positions. It helps with securing your capital by taking you out without your interference, which it does. Take profit, same, but then with profit, automatically close your position when the price reaches your target. It helps secure profits when you're feeling greedy. Always use both. And then also, there needs to be a part in your trade plan about position sizing. Use the risk per trade to determine how many units to buy or sell the contract based on your stop loss distance. For example, if your stop loss is 20 points, your risk is $100 with a normal contract size. I'm not going to do any technicals here, just a numbers example. Your position should be 5 contracts. Do not fall into the mental trap, greedy or like tilted, of decreasing your stop loss by 50% and then doubling your lot size. So your stop loss is not 20 points, but 10 points. Your contracts are not 5, but 10 contracts. You will risk the same $100, but you will lose more than you want. And this is called greed. So have a healthy stop loss. Have your lot size accordingly to that. Don't be that greedy guy that just greedy person that just move their stop loss up or make it more greedy to get higher upside. It's not worth it. Be a professional trader. Implementing robust risk management techniques is essential for long-term trading success. So by determining your risk per trade, using a stop loss and take profit, and calculating your position size that matches your risk profile, you can protect your capital and trade with confidence. You know exactly what to do. You see your setup, you know where your TP is, your stop loss, you know your lot size. It's very easy. You just shoot and wait and make money. And that's the fourth item on the checklist. Final one is the trading schedule. Set your trading hours and create routines. Determine when you will actively trade based on market hours and personal availability. If you trade Forex, for example, consider trading during the peak hours like London or New York session for better volatility and liquidity. And you need to have a pre and a post review routine. Your pre-trade checklist should be reviewing your trade plan and market conditions, conducting a technical fundamental analysis, and setting up your charts and tools for the trading session. Also, when you have traded, there should be a review moment. Analyze what works well and what didn't, identify emotional factors that influence your decision making, and adjust your strategy as needed based on the insights. So it's not that you change or adjust your strategy based on you took a loss and now you're going for a whole new strategy. No. You look at what went wrong in your execution, what you could control, and that is what you're going to improve over time. If you are consistently executing your edge and your win rate drops and your results drop, well, then you can maybe look at your strategy and see, hey, maybe I can refine it a little bit, but it's more about your execution during your review period. Have regular check-ins with yourself. Allocate specific times for broader reviews of your trading performance. Really important, because otherwise you will just shooting blindly without any improvement. Remember, intentional improvement. You make a mistake, you get feedback from that, you change your behavior because of that mistake to actually learn, and because you learn, you can actually improve intentionally. On a weekly basis, let's say every Saturday or Sunday, assess all of your trades, performance, and did you follow your trade plan? On a monthly basis, maybe on the first or the last day of the month, analyze overall progress towards your trading goals and adjust as necessary. Are you on track to your goals from the first step of your trade plan? And keep in mind, when your life changes, your routine changes as well. So adapt and evolve. Be flexible with your schedule to adapt to changing market conditions and personal life demands. This ensures your trading remains productive, manageable, and I think the most important thing, a fun part of your routine. Like, you are doing this to make crazy amount of money. Or not crazy, just a little side hustle. But if your side hustle is horrible and you have sleepless night of it, it's not fun. So make it fun. Make it fun. Establish a structured trading schedule. Establishing a structured trading schedule enhances focus and discipline. So by defining your trading hours, creating a routine, and conducting regular reviews, you can significantly improve your trading performance and also your accountability because you have check-ins with yourself. And remember, it's all about routines. If you have a trade plan, there is not much you need to think of on a daily basis because you know everything. You know what asset to trade, you know your strategy, you know your risk management, you know when you're going to trade, you have your pre and your post routine. So in that mental battery you have in your head, your routine is so easy. And remember, the easier routine, the less mental capital you need to use. The more daily mental capital, the better your discipline, and you need that on the charts. The better the discipline, the more patience, the better the execution, more wins, and more wins is a happy trader. That's it. That's why you need a trade plan. And if you don't believe me, based on these 5 trading goals, market selection, trading strategy, risk management, and your schedule, let's look at 2 hypothetical traders. And trader B with a trade plan. Let's look at trader A. A retail trader has been trading Forex for 6 months without a defined strategy or trading plan. So what this person does, trader A enters trades based on tips from online forums or social media or some nice Telegram signal group. I know you guys have been in there. I know it. Without proper analysis or risk management. You're just taking trades blindly without even thinking. Then their emotions from trader A comes in. After experiencing a losing streak, trader A starts revenge trading, trying to recover losses by increasing sizes. Trader reacts impulsively to news events, enter trades based on FOMO rather than well thought out strategy. And it makes sense why trader A does it, because the trades are random. Like, I will be emotional. I will be very emotional trader if my trades are random. I'll be very panicked every time I was on drawdown. That's why I need data. That's why I need to plan. And what's the outcome of this? The outcome is drawdowns. Trader A suffers a significant drawdown of 30% within 3 months due to inconsistent trading, poor risk management, and emotional decisions. And I think 30% is still quite good. I think most traders just blow their account. Trader A has lots of stress and anxiety. The emotional turmoil leads to burnout, making Trader A reconsider the trading approach, but without clarity on how to improve. And don't forget, Trader A loses most of his money and slowly and steadily loses interest and start a new dropshipping side hustle. Because trading didn't work out, trading was hard, trading is a scam. I think everybody knows this person. And maybe it's good to look at someone else, Trader B. Because Trader B, with the cool hat, Trader B is an experienced trader. Even if Trader B is not an experienced trader, even as trader, but this Trader B has developed a comprehensive trading plan before entering the market. Scenario: Trader B follows a systematic approach based on technical analysis, clearly defined entry and exit points, and well-established risk management rules. Remember the trade plan? Follows to the plan during trades, utilizing a pre-trade checklist and maintaining discipline even during volatile market conditions. Trader B has a very easy routine. Because of the easy routine, better discipline, more patience, happier trader. Trader B has a very easy risk management system. Risk 1% of the trading account on each trade and uses stop loss orders to mitigate big losses. Also, Trader B engaged in regular performance reviews to analyze trade results, and maybe Trader B listened to this teaching and actually applied this teaching. The outcome: Trader B has consistent, predictable results, achieves a win rate of 6% over 6 months, leading to a steady account growth of 50% during the same period. I think the most important part is Trader B maintains a calm and rational mindset. The neocortex, remember? No limbic system, no reptile brain, no fight or flight, a rational mindset. Reducing stress levels. Stress levels come from the reptile brain, and improving, because of that, Trader B's overall trading experience. And remember the compound effect. Trader B is here. Trader A is here. It's your choices, making your trade plan and making choices based on that. Behavior, are you following your trade plan? It's your habits, your routines, and then let time do its thing. So with Trader A, made random choices, making that the -1 per day automatically. Random behavior, probably not the best one. There were no habits because there was no journaling. There was no trade plan. There was no consistency, nothing. It was random. And then time will put him here. And Trader B, complete opposite. Had a trade plan, had good choices based on the trade plan. Because of the easy routine, the behavior was amazing. Good habits, because you can actually structure your life if you have a trade plan. So your habits can be very nice. And he will always over time end on top. The difference between Trader A and B at the start, don't get me wrong, guys, you can start together with a friend of yours when you're trading. At the start, maybe the first few weeks, you will notice zero difference. You're like, oh, this friend of mine is also doing well, and he makes some money, and he loses some money. But if you are the person who chooses, it's a intentional, like it's an actual choice to do this. Make your trade plan, follow it, journal, build data. Over time, every single person who does not do it, you will be miles ahead of them. And it's not a competition, but I don't think you want to be at the same level as your loser friend in a few years. It's your choice. So, takeaway. I think the picture says it all. We have a happy Trader B. We have a sad Trader A. A clear, acceptable trading plan is crucial for your success. Trader B's disciplined approach results in more consistent profitability, better emotional control, and reduced anxiety compared to Trader A, who suffers from chaos of emotional trading and a lack of structure. And a recommended read based on this teaching is Darren Hardy's Compound Effect. Jumpstart your income, your life, your success. You have already heard about the compound effect many times in this market mastery course, and I would think this read is going to be amazing for you. I'm not going to spoil anything. It's a gem. And I think a book is the best investment you can make in yourself why you now, for like $20 or whatever it is, you can get access to Darren Hardy's amazing frameworks on how to make your life better. And yes, you can use these frameworks in your trading. The trader pyramid. In the previous teachings, we already covered psychology, the foundational layer. We discovered the trade plan. And this teaching, we're going to talk about journaling, data collection. You need to build data on your trading ASAP. You can do this in two ways. First is looking at the past, historical data, best performance is backtesting. Second is looking at price in real time and journal that. Tools for backtesting, you can use TradingView with the replay button, or you can use FX replay. No affiliates, but if you use, I think DionTrades as code, you can get a small discount. I think it's like $10 or something. If you use it, it's free money, so go ahead. Tools to use for journaling, Notion and Edgewonk. I use Edgewonk myself. Notion is a free tool with amazing templates. So both are very fine for data collection. What to include in your trading journal? This is a question I get asked so many times. And guys, it doesn't matter, first of all, which platform you do. I don't care if you do it in a Google Sheet, in Excel, I don't know if you do it on a whiteboard. I don't care. Just do it. And because journaling is for so many people a hard thing to do, they cannot stick to it. Maybe you should make the barrier of entry to do it very low. Try to make a system for yourself where you only need to spend like maybe 2 or 3 minutes per trade, maybe even less, to journal. And you need to have at least 4 things in your trade plan. First, your trade details, screenshots, entry and exit points, trade size, direction. Second is market conditions, why you press the buttons, this is your trade plan. And your emotional states, thoughts and feelings before, during, after the trade. And it's very simple why you must journal, right? It provides a comprehensive view of your behavior. It helps identify strengths, weaknesses, and areas for improvement. And it encourages accountability and self-reflection. We talked before about if you want to do this professionally and actually want to make some big money and even want to trade for like multi or hundreds of millions with hedge funds, the first thing they're going to ask of you to verify if you're an actual trader or you actually have skill is your data. That means from day one, or let this be your day one, just start building your data. It doesn't need to be good. Like maybe you have a horrible data. You just blow some accounts, but that's a baseline, which is actually amazing. Because you can just show them like, hey, I started building data here on day one. I was all over the place. I heard a guy on a teaching today, in this day, say, maybe I should start journaling from day one. I did. I improved. I actually started focusing on intentional improvement. I learned. I changed my behavior based on feedback I got from the market, and I grew over time. So they see your baseline today while I watch this recording, and maybe in a few months, few years from now, they see, whoa, this person has grown so much. We should hire this person. This person taken seriously. And trading for hedge fund guys, there's some big money there. So if you wanted the same for everything, if you want to maybe do some coaching on the side, you want to help people with trading, they will. The only way people will believe you is if you can show like, hey, for example, I'm funded or I have some payouts or whatever. Data. If you don't have a journal, that's fine. But this most important, the second one, and you're not willing to do it, by all means, stop trading. Just stop. You will probably lose all, or at least most of your money. And that's not today. It's not going to be next week, maybe even not next month. But because you don't have any data on your trading, you don't know what to improve, and you will be a victim to the debt by 1,000 cuts. So you make a small mistake here, -%, and your behavior and your results will compound over time. We talked about the compound effect earlier in the Market Mastery course. And not journaling, so not actually knowing what to improve on your trading, is going to be the starting point of that. So I think the message is clear. Start journaling from today. Make it as easy and lower barrier of entry as possible. If you don't want a fancy Notion template, you don't need that. Start with a simple Word document or Google Docs document with screenshots and this, and grow over time in this. what tools to use. You've a choice between free and paid tools. Free tools, Notion, Google Docs, Google Sheets, Excel, Word. It's a great way to start. Most people cannot even start. Just start today. First step, create a journal. Keep in mind that maintaining this takes more time than paid tools. Paid tools like Edgewonk or Tradezilla are more expensive, but they do more automated work for you. So it's more efficient over time because they will collect the data for you and create automatic reports and feedback loops. So I would recommend, if you don't have a journal yet, just start with free and then transform over time when you make some money into paid. It's a cool thing, right? To make some money in the charts and reinvest that in better tools, like for example, a better journal. I use Edgewonk myself, and it's an amazing tool to use. No affiliate, just happy customer. The difference between the losing 95 and the winning 5% of traders is very easy. The winners approach trading as a business. We're talking about data, journaling, backtesting. A business has revenue, expenses, and a business is built on data. Your revenue is your payouts from your broker or your prop firm. Your expenses are the fees from your broker, but also, of course, for maybe your journal or prop firm challenges. You need to have that all marked out in a sheet or by your bookkeeper, by your accountant. Your trading business needs data to perform. So let's start. You have two choices, a random approach and a data and trust building approach. The random approach is spend 6 months taking random trades, hoping for the best, making mistakes, and continuously losing money due to lack of data. Is that stick figure, trader A, we talked about before in this course. Are you sure you want to be this person? I would recommend going for trader B, data and trust builder approach. Spend 6 months with a focused approach, intentional improvement. Deposit, let's say, I don't know what your bankroll is, but let's say between $100 or $1,000 in a broker, and get to know every single data point of your routine, your execution, and journal everything. The goal here in the first 6 months is not to break the bank. It's not to make money. It's to build data so you have the data to actually scale. And yes, you will make some money. If you have $100 or $1,000 in your account, you will make some money, some funny little side cash. But you're not making the tens of hundreds of thousands of dollars yet. But the thing is, if you know your data, you know exactly your win rate, you know your risk to reward, you know your losing streak, your winning streak, you know what triggers you have when you are going on tilt, like the whole 9 yards, the whole trader pyramid. If you have data on this, then you can just increase your lot sizes based on the data. So maybe you are usually risking $100 per trade. You're risking $100 per trade or $10,000 per trade. The only difference is your lot size, your contract size. So you can easily do that. But I would recommend only doing that when you have the data to back up that you're actually ready to do this. So if you have proven to yourself, to build confidence, if you have proven to yourself, I have data because I journaled everything and I backtested this, I know exactly what I can predict if I execute like this, what I can get out of the market. You can scale, you're ready. But the reason so many traders fail is they are, I think it's or ego or they're lazy. I don't say you are that, but most traders I talk to, which I help, one of the two. Or they don't know how. They are not willing to spend 6 months with a focused approach. 6 months is long. It's long. That's why in the first teaching of this market mastery course, I went over how I would put my 6 months, like if I would start over, how I would do my 6 months. And data collection is key in this. Everyone wants to achieve that magical 10K a month within a few months, but for almost everybody, that's not the correct approach. Because you first need to know your win rate, risk to reward, losing streak, winning streak. You need to have your playing field ready. Your playing field provides feedback every single moment, indicating if you are still on the correct playing field. And let me go deeper into this. If you notice you are outside of your playing field, so your playing field in this example was you have your biggest losing streak is 9, your biggest winning streak is 5. If you go over 9 losses in a row, that means 10 losses in a row, then there should be a red flag. Like, hey, something is out of my playing field. I need to start my feedback loop. If you have 8 losses in a row, you don't need to do anything, because your playing field is 9. You know, in your trade plan, in your trading experience, in your execution, based on your months of data, you know that sometimes a 9 losing streak is part of it. Can happen. And it's fine. That's fine. Yeah, of course, it's not fun, but it's part of your playing field. So if you notice you're outside your playing field, having a bigger losing streak than 9, or let's say your win rate drops from 50 or 40 to 15, it's time to start a feedback loop. I'm going to show you how that feedback loop looks like in a second. And the cool part of this is, if you're playing within your playing field, so 8 losing streak, or maybe you're still at 40% win rate, there's no need for insecurity. Like, oh, I'm a bad trader, I lost 8 trades in a row. It sucks. It sucks 8 trades losing in a row, but it doesn't make you a bad trader, because it was part of your playing field based on your specific personal data you collected yourself. Just know, okay, I'm in a losing streak, just executing. I know based on my playing field, the wins will rack up again. There's no need to be insecure or emotional when that inevitable losing streak occurs. You will get in that losing streak, guys. You will. You will. You simply know it's part of your playing field. So no panic. And the thing is, other side of the coin, if you don't have data, and this is maybe the key why so many traders fail, you don't know that based on your data, you can get it at 9 losing streak. And you don't know this, but all of a sudden, you encounter a 5 trades losing streak. Ooh, you will panic. You will panic. 5 trades in a row. I'm studying so hard. I'm putting on the work. You don't have any data. So maybe stop watching videos and actually build data on your trading. So go back to your last 30, 40, 50 trades and journal them. And see what data comes out of that. What's your win rate? What is your biggest losing streak? All traders will just go back on YouTube, buy a new course, get a new mentor, and probably switch strategies altogether. But the thing is, guys, if you switch strategies, you need to build that whole fucking 6 months again. Why would you want that? Why would you want that? You're doing such an amazing job. You're building data. Even if you're not on a 6 months, maybe this is your first week of building data. I applaud you for that. Amazing. Keep going. But the second you switch strategies, you just hit the reset button on the work you did before. And there's a difference between switching strategies and enhancing your strategy. Switching strategy is looking at all different confluences, things you want to see in the market. Enhancing your strategy is little A/B testing. Maybe you've done some marketing before, that you're tweaking one single thing from your trade plan. Maybe you're not shooting a 1 to 2, you're gonna go shoot a 1 to 3 and then test it out. That's enhancing, a little bit. Core is the same, you're tweaking one thing at a time. Huge difference. So you'll probably switch strategies because of the panic, thinking it will not work anymore, but only if you lose more than 9 times. Then it's time to start your feedback loop, to review and reflect. And most of the time, if you're outside your playing field, this example 9, you're at 11 or 12, you will see that maybe 30-40% is based on your mental game. So the first losses were based on your edge. You get frustrated. You're like, fuck this. I'm just going to shoot more. And you saw that B setups occur in your trade plan. Well, based on the review and reflect, your feedback loop, that's a very easy fix. So don't be hard on yourself on this. When it happens, like, okay, out of 30 losing streak, I know 7 were actually my edge. The rest I was just a degenerate piece of shit. I was shooting B setups. Fine, because the thing is, remember from learning, you now have feedback from your journal, your feedback from your data. The only way you learn is changing your behavior based on that feedback. Well, what has changed your behavior? Well, find your emotional triggers who cause that. So next time you know it's gonna happen, you know exactly, like, oh wait, remember the last time I had a 13 losing streak? I did X, Y, and Z. It didn't help me at all. I shouldn't do that. I should do A, B, C. That's a feedback loop. So the team on the left has data on their trading. The team on the right does not.
On which side of the playing field do you rather play? I want to be in this team where I just kick the ball and gravity will work me towards the opposite side of the field. And I think you should too. Data, no data. You are battling an uphill battle. You're walking uphills. It's just not worth it. Data is not only collected via journaling. It's also collected via backtesting, looking at historical data. And I will leave a link below on a demo I made via FX Replay where I test a silver bullet entry model. So check it out if you are not sure how to backtest. If you already know how to backtest, don't go watch this because you're just gonna Netflix and just do nothing. If you know how to backtest, you know how the replay button works on TradingView, you know how FX Replay works, just do it. Just backtest your model. Come on, guys. Don't watch this. You're not allowed to watch this if you know how to backtest. Only if you're new to backtesting. And maybe you find out by now, I want you to do something. Not just watch this, I want you to actually improve. Because without you doing the work, putting in the work, you're not going to improve. And you can watch hundreds of more courses like this, or maybe another one, free or paid. Imagine paying hundreds or maybe thousands of dollars for a course and you're just watching and not doing anything. Dangerous, dangerous, dangerous. I said this before, my mantra is very simple. Don't spend too much money on courses, spend the majority of your money on mentors. It's way more important. Mentors show you the shortcuts. And now it's time to talk about the feedback loop. How does a feedback loop look like? And again, don't make this harder than it should. I know where you want to start. Let's say you start taking a trade, you journal that trade, then you analyze your journal. Based on the data from your analysis, you can backtest. When you have backtest, you know what works, what doesn't work. You can refine your strategy while backtesting, and with that refined strategy, you can come back to the charts and take a trade again. This should be always your feedback loop. And this should activate when you are outside of your playing field. At the start, when you don't have a playing field, is just doing it. Just doing it. When you have 6 months of data, you will notice that you can just do the boring work, that's just executing your edge. When you notice, while executing your edge, you're outside your playing field again, start the feedback loop again. But there comes a point in your trading career that's amazing, and most traders call that like when it clicks. That's when you have built your data and you have confidence in like, hey, if I execute this exact model, I can expect this in return. You don't need to have many feedback loops by then. But that's later down the line. When you don't have this, you're strategy hopping, you're not sure what to look for in the market. This is what you should do. Journal, analyze, backtest, refine, trade, and then do it all over again. A recommended read to close out this teaching is Tom Hooker's Best Loser Wins. Why normal thinking never wins the trading game. And I talk about in every teaching about why the 95% doesn't make money and why we need to focus on the 5%. I learned so much in this book. It's more of a psychology book. It's not like Trading in the Zone. Maybe you already said. I don't recommend Trading in the Zone. It's an amazing book, but I don't know. I think there are better books out there. Best Loser Wins for $20 or whatever dollars. You can get insight in Tom Hooker's head, one of the most amazing traders you'll ever see. So strong. And I'm not going to spoil anything, but I would definitely recommend picking this book up. I won't share any Amazon affiliate links. Just get it, and maybe if you do a good Google search, or maybe you ask a trading friend, maybe you can get it for free. But just get it, get your hands on it. So, psychology, trade plan, now data collection with journaling and backtesting. In the next and final section of the trading pyramid, we're going to talk about the charts, the technicals, what you want to see in the charts before pressing the button. Very interesting, very interesting. It's time to dive into the charts. The frameworks you're about to learn made me quit my 9-to-5 job and travel all around the world. And you might wonder, why give all this away for free? It's very simple. I make money already in the market and I'm on one single mission. And it is to help at least 10,000 traders to become profitable before 2026. And we already have a massive group on School where there's already so much value being shared by an amazing group of traders. And we're just getting started, actually. And this market mastery course is my gift to you. Learning is two things, guys. You need to remember this, what to avoid, and stop doing that. And then focusing on what's already working and doubling down on that. First, we're going over what you should avoid with using technicals, so what not to do. And then we're going over the technicals I use to make money in the market, so what to actually do. Disclaimer, 95% of traders lose money. That means 95% of your behavior, your automatic behavior, is not going to work. So we're going to focus on the 5%, like me and you, very soon, to do and become profitable and actually making money with trading. Trading is the hardest way to the easiest money, guys. Remember this. The hardest part we're going to tackle in this course. The easiest part is you then actually being able to apply this and getting some money out of the market. Disclaimer for some expectation management. Spend or invest at least 6 to 12 months in this. Building your foundation, get data, and don't expect to make any significant money. You can even lose money. I'm 100% sure you can already make money within 6 months, but the data is stacked against you. So keep that in mind. If this scares you, oh, I cannot make money in my first 6 months, fine. Go dropshipping, go affiliate marketing, go do something else. This will not be for you. But, if you're still convinced you're going to make it with trading, amazing. Take out your notepad, and it's time to get to work. Let's do it. We arrived at the top of the trader pyramid. We already went over psychology, went over trade plan, went over building data with journaling and backtesting. At the top of the trader pyramid, so you have your whole foundation. Now we're going to talk about technicals. This means, guys, if you struggle with trading, maybe you're not a beginner, you're trading for 5 years already. Don't care how long you're trading. What 95% of traders do when they're in a losing streak or they're not profitable, they're only focusing on the top of the pyramid. But you know now, the upcoming 5% of traders, that fixing your technicals is not the issue. It is fixing layer 2, 3, and 4 first. Yes, of course, focus on technicals. But the technicals is such a small area of trading. Nobody on Twitter, Instagram, or whatever talks about this. That's the reason I make this course. I want people to be aware of this. And maybe when it's released, you see this all over Twitter. Like everybody's talking like, oh, don't focus on technicals. The rest is more important. You hear it here first. When you are in a losing streak, when you're not profitable yet, don't go build a new technical model. Don't watch hours on technical analysis. No. It's focusing on psychology, focusing on building your trade plan, refining that, creating feedback loops and creating data based on a simple entry model. Don't make it hard. You can make money with the most easy entry model ever. Technicals are what you want to see in the charts before pressing the button. Not your mentor, not me, not some other guy you met, not your best trading friend. It's you. It's all you. It's an individual game. And there are a few trading languages you can speak. Just like you can talk English, or you can talk German, or you can talk French or Spanish. In trading, exactly the same. And you need to learn a language. So a trading language, just like a regular one, is a way to communicate with price action and a market in general. There is no good or bad, right or wrong in the decision to choose a certain language. All of them will make you money while executed consistently. Here's where most traders go wrong. They first go to support and resistance, had a few losses in a row. They're like, support and resistance is not that. Let's go to ICT, to smart money concepts. The 3 most used trading languages are support and resistance, supply and demand, and ICT. They both have factors that overlap with each other. Personally, I trade ICT. Let's look at these 3 languages a little bit closely. traders use support and resistance level to identify price points on a chart where the probabilities favor a pause or reversal of a prevailing trend. So price goes up, it hits the resistance level, goes down, hits the support level, so it goes lower from a resistance, goes higher from support. Support occurs where a downtrend is expected to pause due to a continuation of the demand. Resistance occurs where an uptrend is expected to pause temporarily due to a concentration of supply. Support and resistance areas can be identified on charts using trend lines and moving averages. This is all basic. There's so much more to support and resistance, just like, of course, every single language, not only a trading language. Supply and demand zones are areas on a price chart where the price of an asset tends to stall or reverse. You see it right here. They represent areas where there's a significant concentration of buying or selling pressure, which can impact the direction of price movements. So you have a supply zone, it's right here in the red, and you have a demand zone. A supply zone, there's an excess of sellers, causing the price to drop. This occurs when supply exceeds demand and traders are willing to sell at a lower price. Vice versa, for a demand, there's an excess of buyers, causing the price to rise when demand exceeds supply, and traders are willing to buy at a higher price. So it is all the basics of supply and demand, just like the basics of support and resistance, but just to give you a little overview on how a trading language looks like. The third one, Inner Circle Trader, ICT, is the one I trade. IC concepts and SMT in general both deal with liquidity, inducement, imbalances, manipulation, premium discount, so many different factors, different frameworks. IC talks about IBDA, the algorithm that delivers price and the big money. And the banks are using that. Learning ICT is basically learning how to trade like the banks, like the big money. Here's a depiction on one of the ICT frameworks. With me as your teacher, you will make money using ICT. I don't trade support and resistance. I don't trade supply and demand. I am not the guy who says now, like, that doesn't work. ICT is the holy grail. No. That's completely wrong. And I think that's very limited thinking. I think, I mentioned this before, you can make money with every single trading language, every single indicator, as long as you execute it consistently and build data on it. In the next teaching, you will learn ICT trading in under 90 minutes. I will go over all these concepts you see here in this picture in 90 minutes. I think it will be a game changer if you are interested in ICT trading. If you want to learn more in depth, like more specific teaching on this, I'm going over it quite fast. There is a 2024 mentorship on YouTube, on my YouTube channel, DionTrades, where I go over most ICT concepts in general. There's a link below where you can visit that 2024 mentorship. But for now, I would definitely recommend after you watch this video to go in this video, ICT under 90 minutes, because it will be an actual game changer and is needed to complete this market mastery course. And then a recommended read. And The Third Door by Alex Banahan. There's a reason I put this at the end of the market mastery course. I know 80 or 90% of people who started the market mastery course did not make it to the end. That's why the most important framework, the most important book, I left for here. Only for you, the person who sat through all the teachings, and I think you deserve this. The Third Door is a framework I've used, and that's the whole reason why, for example, I'm not doing what I'm doing, why I'm not going to travel the world, why I quit my 9 to 5. I even met Alex Hormozi, which is like a dream for so many huge entrepreneurs. And it's all part of the Third Door. And the Third Door is a nightclub analogy where it states that in a nightclub, there are 3 doors. The first one is the most normal one, the conventional one, where 90% of people wait in line, and the people in front of the line usually go in, and the people at the back are left out. That is your classic 9 to 5. You wait for a promotion, you wait for life to happen to you, and you just wait. You're standing in line for the first door. Then there's the second door, the VIP one. The one where people with power and the blessed ones go in. For most people, there are only those 2 doors. Like, or it's the haves, like the VIPs, second door, or it's the have-nots. the regular middle class 9 to 5 who just wait for life to happen to you. But there's the third door. There's the third door, a secret door. And there's always a third door. This can be a door for the kitchen, or the back of the nightclub, or a fire exit. But most people are not welcome through this door. You might need to bash the door 100 times or wait for hours to find the perfect opportunity to get in. But it is possible to go in through this door. And whatever you are now in life, wherever you want to go, for me, for example, meeting Alex Remote, huge example. For me, what I'm doing with business, I think it's so important to know, like, whatever you do in life, maybe you're stuck in 9 to 5, there's the third door to go where you want to go. In trading, there is a third door. Maybe you're struggling with trading. There is always a third door. Maybe in your relationship or with your friends, you are stuck there, or you're in other relationships. There is a third door, the one nobody knows, but you need to find. So that's why, again, you deserve this, to know this framework. I never talk about this in any of my videos, so I'm very happy to share this with you. And definitely pick up the copy of the third door. If you can choose one of the books I recommended, do this one. Start with this one. And now you know the entire trader pyramid. So you know about how you fix your psychology, you get some frameworks, you know what you need to include in your trade plan, how to make that, you know why and what you should include in your journal and how you should build data. And in the next teaching on the ICT in 90 minutes, I will give you the whole framework, what you need to know about trading ICT. You can actually go into the charts and make some.
Alright, welcome to this ultimate beginner guide to ICT trading concepts. This video provides a complete overview of the foundational principles in the ICT method, organized for easy understanding. This method can be quite detailed and may feel overwhelming at first. After watching this video, you will know everything you need to know about ICT trading. So without further ado, let's dive into the concepts of swing points and liquidity. First concept we need to grasp is the idea of swing points and a connection to liquidity. Swing points can be either swing lows or swing highs. To identify them, we look for a pattern involving 3 candles. In a swing high, the middle candle has a lower high on both the left and the right. In a swing low, the middle candle has a higher low on both sides. Understanding swing points is crucial because many retail traders place stop orders just above swing highs or below swing lows, indicating that these areas are rich in liquidity. In a long trade, stop loss and take profit targets are set as sell orders, while in a short trade, they are set as buy orders. This brings us to the concept of buy side and sell side liquidity. Just above the swing high, there are many stop orders from short trades, buy stop orders, and buy stop orders from traders looking to enter long positions if the price exceeds the swing high. In IST terminology, this is referred to as buy-side liquidity. On the other side, just below swing low, there are numerous stop-loss orders from long traders, sell-stop orders, and sell-stop orders from traders intending to go short if the price drops below the swing low. This area is known as sell-side liquidity. Identifying these buy-side and sell-side liquidity level is a significant aspect of the IST method. Now, let's examine a real price chart to see examples of these liquidity levels in action. Currently, we're looking at GBP USD at the 5-minute chart. And up here, you see we just created a swing high. Why is this a swing high? Because of a lower high to the left and a lower high to the right. After we made the swing high, we traded lower, lower. And now this low is potentially a swing low if the next candle is making a higher low to the right. After we traded higher, this high can be a swing high when the next candle is creating a lower high to the right. And we don't be trading higher. So same here, this can be a swing high when our next candle is making a lower high to the right. Then we trade lower, creating another swing low down here. Why? Higher low to the left, higher low to the right. This is going to be a swing high when the next candle creates a lower high. It doesn't. Trades higher, breaking this swing high. Now here we create another swing high, lower high to the left, lower high to the right. And now this low can be a swing low where the next candle creates a higher low. It doesn't, but it does right here. And price goes higher. Where does it go? You see a swing high right there. And here you have 3 swing highs in a row. So next to swing highs and swing lows, when you see multiple swing highs in the same area, this brings us to the concept of equal highs and equal lows. In this chart, you see multiple swing highs clustered together. And in the ICT method, we call that equal highs. At the bottom here, you have multiple swing lows clustered together. And we call those equal lows. The difference between equal highs and lows and old highs and lows is that old highs and lows are isolated, triggering liquidity.
with the equal highs, there's a swing high created right here, taking out all the buy side liquidity that was resting above here. It triggers liquidity to go down again. And the same happens down here. Price breaks a swing low after taking all this sell liquidity, triggering liquidity to go up again, taking out an old high, triggers liquidity again to then go lower, taking out this low. And what you see right here, where price takes out a sell side liquidity pool and then fails to displace lower but goes higher, is called market manipulation, meaning the triggering of liquidity in order to deceptively induce retail traders to one side of the market, but then it goes the other way. Still on the topics of highs and lows, we can identify other significant types on the charts, such as previous week highs and lows, previous day highs and lows, previous session high and lows, and even intraday time frame high and lows. We will revisit these concepts when we're discussing daily bias later in this video. Another key concept of the IST method is the idea of premium and discount. To grasp this, we first need to understand the concept of a range, which is simply the space between a swing low and a swing high, or vice versa. For illustration, let's consider the range from a swing low to a swing high. To define the premium and discount zones, we divide the range into two equal parts. The upper zone is known as premium, and the lower zone is called discount. This applies similarly when the range is from a swing high to a swing low, indicating a downward price movement. When seeking long trade opportunities, we aim to enter the trade in discount zone, especially if other factors support the trade idea. The deeper into discount we enter, the better the risk to reward ratio, with the stop placed below the swing low and the target at the swing high. For downward price movements, we measure the range from a swing high to a swing low and aim to enter short in the premium zone. The higher into the premium we enter, the more favorable the risk to reward ratio, with the stop loss at the swing high and the target at the swing low. This concept of premium and discount is straightforward, but crucial when considering other elements like optimal trade entry, fair value gaps, order blocks, and the combination of other factors that generate your trade setup. Directly related to the concept of premium and discount zones is the idea of OTE, which stands for optimal trade entry. OTE refers to a specific Fibonacci retracement zone that falls within the discount zone for a long trade and within the premium zone for a short trade. This particular Fibonacci retracement zone ranges from 0.62 to 0.79, with the midpoint at 0.705, being especially significant. In this illustration showing the OTE for a short trade, the zone falls within the premium zone. It's crucial to observe how price action interacts with the three levels in the zone, particularly with the midpoint of the OTE retracement level. The same concept applies for a long trade. In this illustration, you notice that the zone clearly falls within the discount zone. Observing how price action responds to the level within this zone, especially the midpoint of the retracement level, is just as important as we saw at the long trade OTE. Let's look at some specific examples to illustrate these concepts further. Currently, we're looking at Euro US dollar at the 4-hour chart, and the swing high and the swing low of this current range are already marked out. So the first step we need to do is mark out the premium and discount. The difference between the swing high and the swing low is your current range, and the top side is your premium, the bottom side is your discount zone. So now we have premium, discount, and the OTE levels. So we want to see what price does when it reaches one of the three OTE levels. And remember, the higher up into the range, so in the short trade, the higher up into premium, the better your risk to reward will be. So playing two candles forward, we see that price comes into the top of the OTE area, deep into premium, and the body is respecting the OTE area. Let's see what the next candle does. The next candle does it as well. And then we see an energetic move lower, reacting from that OTE area. And a few candles later, we see that price goes down. If you would have taken a trade from the midpoint of the OTE area, with your stop above the swing high or take profit at the swing low, you would have a 1 to 2-4 risk to reward, which is pretty decent. And later we see that price has still some more down movement in it, but you already got some nice profit in. Currently, we're looking at NASDAQ at the 4-hour chart. And already any swing low and swing highs are marked out from this range. Now let's see how premium and discount looks like. And if you want to go long, you want to go long in discount of the range. And also you want to long inside OTE in that area. So when you place your Fibonacci from swing low to swing high, now you have your OTE area. So you want price to come back to this area to take a long. So let's see what price does when we are there. So you can take a trade from the 0.61 area, but preferably the deeper into discount, the better your risk to reward will be. And we're going to focus on taking a trade from the midpoint of the OTE area, with our stop loss below the swing low, and our take profit above the swing high, for this time at 1 to 235. You see that price comes
back into the discount of the range. We touch it, we go a little under the midpoint of the OT area, and then price moves higher, giving you some nice profits. A key concept in the IST method is the fair value gap, which is a 3-candle pattern that shows a gap between the first and the third candle shadows. Let's first explore the bullish fair value gap, also known as a BISI, which stands for buy-side imbalance, sell-side inefficiency. In this pattern, the first candle's high does not overlap with the third candle's low, creating a gap. For comparison, if there is an overlap between the upper shadow of the first candle and the lower shadow of the third candle, as shown on the right, there is no fair value gap. Similarly, the bearish fair value gap, often referred to as a SIBI, sell-side imbalance, buy-side inefficiency, occurs when the first candle's low does not overlap with the third candle's high, creating a gap. As similarly to the bullish example, if there's no overlap, there's no fair value gap. An important detail about fair value gaps is the concept of consequent encroachment, which refers to the midpoint of the fair value gap, or the 50% retracement of the gap. Fair value gaps can act as zones of support and resistance. Observing how price interacts with the limits of fair value gaps and the consequent encroachment line is crucial. In the ideal scenario for a bullish fair value gap, the price pierces the upper limit and closes above it, indicating respect of the gap. A similar reaction at the consequent encroachment, where the price pierces the midpoint and closes above, can also indicate respect for the gap. In the bearish version, the principle is exactly the same, but reversed. Price can also disrespect the fair value gap, leading to what is called a inversion fair value gap, where the price tests the gaps on the other side and then moves away. This concept is similar to the classic test of support and resistance lines. The concept is the same for both bearish and bullish inversion fair value gaps. And beyond fair value gaps, the IST method also includes concepts like volume imbalances and gaps. A volume imbalance occurs when there is a gap between the open and close of two candles with overlapping wicks. The gap is in the bodies. A gap, however, occurs when there is a space between the high and lows of two candles with no trading activity between these points. In the case of a bullish gap, this gap exists between the high of the first candle and the low of the second candle, and the bearish gap, it exists between the low of the first candle and the high of the second candle. In this illustration, you can compare the bullish versions of the fair value gap, volume imbalance, and the gap side by side. With the fair value gap, there's a gap between the wicks of candle 1 and 3. In a volume imbalance, there's a gap between the bodies of the two candles. In a gap, there's no trading activity between two candles. Now, let's look at real-world examples of fair value gaps, volume imbalances, and gaps to see the concepts in action. Here we are at the 1 hour time frame on DXY. And in this move up, we have created a gap. There's no trading activities between these two candles. After we run higher, we can expect a move back into OTE, this kind of range, and also now there's an overlapping part with a gap. Price comes back into the OT area where also our gap is and reacts from it. In this price action, we now created a bearish fair value gap. So let's see if price respects it and trades lower, or we disrespect it and then this becomes an inversion fair value gap. It disrespects it, so this is now becoming an inversion fair value gap. And with this candle's close next to the inversion fair value gap, we created a new bullish fair value gap. So now in this movement upwards, we've seen a retracement into OTE and the gap. Then we have a big move upwards, disrespecting a bearish fair value gap, making it an inversion fair value gap. And now we want to see a retest in both the area of the inversion fair value gap, but also the newly created bullish fair value gap to then trade higher again. The next candle does that and then moves higher. Now you look at a 4 hour chart on DXY. And we just had a big movement upwards, creating a fair value gap between the high of this candle and the low of the third candle. And you see how the bodies are respecting the fair value gap to go upwards. A bullish fair value gap should do that. In that movement higher, we created a bullish volume imbalance. And again, this should push price higher. So you see price goes higher, comes back to the volume imbalance, and then trades away. Another key concept in the IST method is the order block, which can be categorized into two types: high probability order blocks and low probability order blocks. High probability order blocks are associated with large body candles, while low probability order blocks are characterized by small body candles with more prominent wicks. Let's first explore the high probability order block. The bullish variation of the order block is formed by a large body bearish candle or a series of large body bearish candles that sweep sell-side liquidity and then lead to a break of an old high, known as a break of structure. The order block is located at the open of the large body bearish candle that sweeps the sell-side liquidity. Price often retraces back to the order block before continuing higher. Bearish variation of an order block is formed by a large body bullish candle or a series of large body bullish candles that sweep buy-side liquidity and then lead to a break of an old low, also referred to as a break of structure.
The order block is found at the open of the large body bullish candle that sweeps the buy side liquidity, and price typically retraces to this level before moving lower. High probability order blocks often emerge from expanding pivot formations, where a lower low is followed by a higher high in the case of a bullish order block, or a higher high is followed by a lower low in the case of a bearish order block. Low probability order blocks, on the other hand, are formed by small body candles with more prominent wicks and occurs in the middle of a price movement. This can also be divided into bullish and bearish variations. In the bullish variation of a low probability order block, the small body bearish candle is found in the middle of a price movement that's primarily bullish. The order block is located in the space between the high and the open of the small body bearish candle. Price often retraces to this order block before continuing upward. In the bearish variation, a small body bullish candle is present in the middle of a price movement that is mostly bearish. The order block sits between the low and the open of the small body bullish candle, and price typically retraces to this level before resuming the downward movement. Now let's look at the high and the low probability order block in action. In this example, we're going to look at the formation of a high probability order block. We have sell side liquidity down here. We see that price is sweeping that liquidity with some aggression and have an aggressive candle upwards. In this move, we created a swing high. When price breaks that swing high, we have a break of structure. The second criteria for an order block after taking sell side liquidity. We take structure right here. So now we can identify this big down close candle to be a bullish order block. Now you want price to come back to that area. The body is respecting the order block and then go higher. If the price comes back here, it will go into the mean threshold of the order block. The mean threshold is the 50% of the body. Also, the 50% retracement of the order block is a key area. The bodies are closing above the area, and then you see price going upwards, respecting the bullish order block. And when we analyze this example, you see that price comes back to the order block 4 times before making the move higher, giving you enough time to enter this trade. And in this next example, we're looking at a low probability order block. We're very bearish right here, anticipating lower prices. And in those lower prices, we see a up close candle being created, making this a low probability order block. Marking out the open of the candle, and what you see most of the time in low probability order blocks, very trending conditions, price just come to the order block and then moves away very aggressively. You see price comes back up here to the top of the order block, but the bodies are closing way below it, and then we go lower and lower. To identify the best trades, the final ICT concept we'll explore in this beginner's guide is the daily bias. Daily bias is a way to determine which direction the market is likely to go based on the previous day high and low, and by observing how the price reacts at these levels. Let's start with the basic idea of a bullish daily bias. Suppose you begin by marking out the high and low of a particular day. If the next day's price action breaks and closes above the previous day high, this indicates a bullish bias for the following day. Another instance of a bullish bias occurs when the price breaks below the previous day's low but fails to close lower. In this scenario, you can expect the next day to be bullish, or at least for the price to reach the previous day high. For a bearish daily bias, the logic is similar but in the opposite direction. If the price breaks and closes below the previous day low, a bearish bias is established for the next day. Additionally, if the price breaks above the previous day's high but fails to close above it, this also suggests a bearish bias for the following day. In this case, the expectation is for the next day to be bearish, or at least to test the previous day low. Like many other concepts in ICT, the daily bias is best understood through practice. So let's hop into the charts to see this concept applied in real time. When applying this framework, you want to mark out the highs and the lows of the previous day. In this example, see the price took out previous day high, but fails to close below it, making the next candle the bias to the downside, till at least the low of this day. Updating the highs and lows, our bias is to be to the downside. And it did, but we trade lower, but we fail to close below it. We closed higher. That means the next day, the bias is higher and at least towards this day's high. Updating the high and low, and we took out the high and we closed above the high. So the next day, we expect price to go higher for at least this day's high. We did, and we closed above the high. So that means for the day after, we still have the bullish bias. And we took the high, but we failed to close over it. So the next day, we anticipate to go for this candle's low. And it did, and it closed below the low. So the next day, we anticipate price to go for the candle's low again, the bearish bias. And it does, taking out the low, but it fails to close lower, it goes higher. So the day after, we anticipate higher prices again. We do, but we fail to close over it. So the next day, we anticipate for price to take out the low. And it does, but it fails to close lower. So now we anticipate the high of the previous day to be taken with a bullish bias. and we take it and we close over it. So the next day we anticipate again higher prices, and then we displace higher. And see what we did here? We slowed down inside a bullish value gap before trading higher again. In all of these days, the bias was correct using this framework. In trading, nothing is 100%, so this will fail sometimes, but most of the time it will be very reliable. You can use the same concept intraday on the lower time frames as well. But keep in mind, the lower the time frame you go, the less reliable this framework will.
How to get funded guaranteed. Step 1, starting point. Start with getting 5 challenges of your preferred size. For example, get 500k challenges. Your initial investment will be around $2,500. If you don't have $2,500 to start with, then you can start at a lower threshold. Doesn't matter. For example, pick 5 10k challenges, pick 5 5k challenges. That will set you back like maybe $100 or $200. This first starting point is very important, and you should be okay with losing this initial investment. If you don't have the money to play with 4 challenges, I would recommend the following. 1. Start with the smallest, cheapest possible options. 5 for the 10k challenges. If you don't have the money for the smaller challenges, then you have work to do outside of your trading. Very important note here. I would recommend when you don't have the money right now to buy 5 new challenges, don't go any further. You have work to do outside of the charts. Why? Your trading will be more emotional and unstable because you treat this as a lottery ticket, which is not. It's trading business. You should take it very serious, and you should be able to lose the money you put into this trading. And maybe you're wondering, why 5 challenges? Why not 1? The rules of prop firms are stacked against you. So with 5 challenges, this way you will be able to spread out the risk of your trades between multiple accounts. And why prop firms? You wonder why not. Your personal capital, because prop firms have a higher upside and a lower downside. With a higher upside, you can get easier funding, for example, 10, 20, or 100k, without spending your own 100k on your trading. And the downside, when you use your personal account and you have, let's say, 5k on a personal account and you blow that account because you had a bad day, can happen, you make a mistake, then your downside is the 5k. But what if you have a challenge of 5k, which is only a couple bucks? Then the only downside you have is not that 5k, but only let's say the 50 or 100 bucks you spent on that challenge. Downside is smaller, upside is bigger. It's a no-brainer to play prop firms. That's step 1. Let's talk about step 2. Buy the challenges. What prop firm to choose? And I make a difference between 2 types of prop firms. 1 is the futures prop firms. Currently we have Apex, Topstep, MyFund Futures, and the non-futures prop firms like FTMO, Alpha Capital, Fund of Next, the Fivers, also referred to as the Forex prop firms. And on the Forex prop firms, you can still trade the Nasdaqs, the indices, the one you trade on the futures. When you are not funded yet, pay attention here. Focus on non-futures prop firms. Why? Once you're funded, it's easier to get a payout on non-futures prop firms than on the futures prop firms. And to make this clearer, I make this depiction for you. There's the non-futures prop firms like FTMO, Alpha Capital. Going from not funding, the challenge stage, to funding is quite hard. It's quite hard compared to the futures prop firms where it's quite easy to get funding. But what you want is the road from funded to payout to be the easiest as possible. Make the challenge hard, but once you're funded, once you pass, you celebrate, let's get that payout very quickly. And with the non-futures prop firms, it's very easy to get a payout. On the futures prop firms, it's very hard to get a payout. So that's why I recommend going for the non-futures prop firms route at the start. After a few weeks or a few months, when you're funded, you have some payouts. Of course, reinvest them back into the futures prop firms to play around. But try to play this game on easy mode. Trading is hard enough from itself. Just try to stay with the non-futures prop firms. And a note here, when buying your 5 challenges, I would recommend spreading them out on at least 2 prop firms. Can also be more, whatever you prefer, at least 2. Don't buy them all on 1 prop firm. You never know if they have a surprise bankruptcy. Past couple of years, some prop firms went out of business all of a sudden. You don't want to have all your eggs in one basket. Lose all your funding in one day. For example, you have 5 challenges, buy 2 FTMO, 2 Alpha Capital, 1 Fund of Next. Maybe by the time you're watching, these prop firms do not exist anymore, but this whole concept applies to every prop firm out here. Second example, 2 FTMO, 3 Fund of Next. You can mix and match as long as you don't have all 5 challenges on one prop firm. And now let's take a look at how to choose the correct prop firm. And I use a website for this. It's called propfirmmatch.com. And I'm not affiliated in any way, shape, or form with this website. I think they're doing a great job of determining which prop firms are legit and which one are not. So when you go to their homepage, propfirmmatch.com, you see here the prop firms, Popular, the Fivers, Alpha Capital, the ones I traded myself as well. But make it easy for yourself. Go here to filters. And what I would recommend filtering on is your country. So for example, some people from the United States are not welcome at all prop firms. So make sure you choose United States. most important, I would say, choose the assets. So if, for example, if you're trading stocks only, look at here. If you want to trade Forex, fill here. Also very important, the platform you want to trade on. If you are very familiar with MetaTrader, for example, pick MetaTrader. If you have never heard of MetaTrader and you want to pick CTrader or NinjaTrader or Tradeovate, you want to trade more on TradingView, fine. Pick the platform you are most familiar with. I recommend as a trader, be at least familiar with MetaTrader and trading on TradingView, for example, with Tradeovate. But CTrader, DXTrade, NinjaTrader, all are very good platforms. You can even filter on the type of steps you want, 1 step, 2 steps. I would recommend going for 2 steps, most prop firms. You can also do 1 step. That means you can pass the challenge in 1 phase instead of 2 phases. But keep in mind, most prop firms have extra tricky rules with the 1 phases. For example, it takes longer to get a payout. You need to have minimum trading days or some form of weird consistency rule. We're forced to make extra trades. And remember, you want to play on easy mode. The less rules from you funded to payout, the better. And once you pick your prop firm, for example, the Fivers, you can go to the website. I think if you click here, you can go directly through the prop firm you want, FTMO or whatever prop firm you choose. From there, go to the website. And then please do your research. And with research, I mean, go to the website. For example, here, Alpha Capital. Again, I'm not affiliated with any of these. But before you buy anything, go through their rules. So for example, here you see the rules. For example, you want a 2-step for 100K or for 5K. And you see, okay, this costs $50. Perfect. You need to have 10% profit target for phase 1, 5% profit target. These are the max drawdowns. Makes sense. But go deeper. Don't be lazy here. Every single prop firm has some form of FAQ or form where they go more in depth about their rules. So here you go to Help Center and here you see FAQ. Click on it. Research this. And yes, those are many articles and most prop firms work quite similar. But I will go definitely through the different articles here. So for example, the alpha plans. This is the 1-step. This is the 2-step. For example, the 2-step, and I want to know everything. Okay, these are the phase 1 targets, phase 2 drawdown. But what do they mean with the drawdown? Is it trading drawdown? Is it static drawdown? How does it even work? Well, another page showed up here. All explanations about the drawdown. I'm not going to bore them with these details right now, but look at the examples. You don't want to be caught off guard here. While you think you're trading according to the rules, but it's very clear on their page that you're probably doing something wrong. Be prepared, do your homework. It's your money and your freedom we're talking about. Make sure you put in the work. And the nice thing about this is you only need to do this once per prop firm. So this will take you maybe 10, 20 minutes to go through some articles and read something, take some notes. Perfect. And if you're not sure during your trade, go back to the same page or type in, for example, can I trade news on Alpha Capital, for example, and then the FAQ page will show you all the details. Also, the max lot size exposure. For example, if you did not read this and you buy a 5K account and you're shooting 3 lot size on it, Alpha Capital will just send you an email like, hey, on our FAQ page, it's very clear that you cannot trade with more than 2.5 lots. You did, so the profits you made with this trade are now invalid. So you took that amazing trade for nothing. Do you want to be in that situation? I won't like that. I think you don't like it too, so might as well do our homework here. Same with rules as weekend holding, trading news. Make sure you do your homework. So when you decide which 2 prop firms you want to trade on, let's say Alpha Capital or for example FTMO, from there you can pick them, register, read the rules, buy a challenge, and get to work. Cool. Now you know what to do. Step 1, buy 5 challenges. Step 2, where to buy it. I would recommend non-futures prop firms. Where can you find them? Look at Prop Firm Match and do your homework when buying them. Make sure not all your accounts are exactly at one prop firm. Make sure you spread them out for at least 2. Now let's get into the nitty-gritty part. And it is step 3, getting to the first funding milestone. And the goal is very simple. You have those 5 challenges. Don't aim to pass them all. Just aim for 1 or 2. Even 1 out of 5 is awesome. Perfect. Aim for 1 out of 5. Personally, I aim for 2 out of 5. And of those 1 or 2, I want for at least 1 to get a payout in that account. Get a payout of at least 2% profit. So for example, you have a 100K account, 1 trade, wants to risk to reward with 1% risk, 2% of 100K is 2K. Most of the time you have an 80-20 profit split with the prop firm. So with a 2% profit, 80% of that is in this case $1,600. With a 10K account, it's a payout of $160. And with that $1,600, with that payout or 160 or whatever payout you have, that's awesome because now you have money to get new challenges and you can stop putting your own money into challenges. It's a waste of your money. And please promise me right now, following. Do not do this. At the end of X time period, I am a funded trader. I'm finished with my challenge of getting 10K funded or 50K funded. You have zero control over how long it will take for you to get funded account. That's out of your control. What is in your control is where you put your stop loss, where you put your TP, where you enter, what your lot size is, when you take a trade, if you journal your trade, if you have actual data, you have a trade plan, you have an entry model that actually works. And I'm going to give you my entry model later in this video. But focus on the things you can control. When you finish the challenge, you have no control over, because even the best trade strategies can stop working for maybe a week or two. So if you are in a unavoidable losing streak, which you will get into someday, and you start your challenge, you're like, oh, well, I took a few losses, this doesn't work, but I said to myself, I'm going to get funded at the end of this month or the end of this quarter, and you didn't hit it. Who cares? Who cares? Don't do it. Focus on the things you can control and let the profits come to you. No rush. Just focus on taking good trades. When focusing on good trades, reviewing good trades, and actually intentional improving, that's all you can do. And that's what you need to do to become a profitable trader. Some of you watching this will pass the challenge in a few weeks. Some will take months. There's no competition. And I bet some of you will beat me in my challenge. And I applaud and support you to do that. So maybe we start a challenge at the same time and I do 3 weeks to finish a challenge. But you are taking amazing trades. You're doing everything right and you pass in 2 weeks. Of course, you won the competition of speed. I applaud you for it. Get funded fast, get payouts fast, get rich fast. But it's not a competition. It's not a rush. Take it easy. Focus on things you can control. And if you beat me with speed, awesome. Awesome. But don't gamble. This is no race. The goal is for everyone to win. And I don't care how long you take. And don't try to be too fancy with your trading. And what I mean by that is the goal is to get to around 35% win rate. So you can shoot for 1 to 2 risk to reward and up to get funded and to make money. And this is what so few people understand. When you shoot for a 1-to-1 risk to reward, you need a 51% win rate to be profitable. With a 1.2 risk to reward, you would need a win rate of 34% to be profitable, because 1 out of 3 need to be profitable. With shooting 1 to 3 risk to reward, you would need 26% win rate to be profitable. So when you shoot 1 to 2-ish, 1 to 2.5, for example, risk to reward, and only aim for 35% win rate, you are good. You're good. And most of the time, when you focus on good trades, you have a higher win rate than 34%. And maybe you don't shoot 1 to 2, but maybe you shoot 1 to 2.4 or 2.5, which is good. Try to match your win rate with your risk to reward. So if you know you have a 34% win rate, which you can track because you can journal your trades, you know, I can only shoot for 1-2s and I'm good. I can make money now. Awesome. Aiming for 35% is very nice because your trading becomes very forgiving. Gone is all the pressure, right? Because for every 10 trades, you can take 6 losses. That's pretty awesome. And even better, for every 100 trades, you can see 65 times your stop loss being hit. And even then, you're not losing money. That's a pretty good deal if you ask me. And this helps a lot mentally, where so many traders struggle when going through a losing streak. Now let's talk about how to pass phase 1. Pro tip, play prop firms aggressively because you want to be rewarded for winning trades. Don't be the I risk 0.25 or 0.5 risk per trade kind of person. Keep that kind of trading for your personal account, but not for prop firms. For phase 1, aim to pass in only 2 trades. So if you have 2 winning trades in a row, it should complete your phase 1. If your target is 10%, you should aim for 5% target per trade. And how you can do that? You shoot 2% risk per trade and you aim for a 1 to 2.5 risk to reward. If you target 8%, aim for 4% target per trade. You can shoot 1.5% risk per trade and shoot a 1 to 6. You can play around with this according to your own preferred risk to reward and win rate. And the 2.5, 6-ish risk to reward fits perfectly in the 30% win rate frame. Cool. Phase 1, gonna pass that. Let's go to phase 2. Phase 2 should be a 1-shot, 1-kill. And most pro firms have a 5% target on the phase 2. So that means you shoot 1.75 risk and you aim for a 1 to 2.85 risk to reward, or which I prefer, keep shooting 2% and aim for 1 to 2.5, similar as you did right here on phase 1. And with 1 winning trade, you pass the challenge. So an ideal scenario, and this is where I want to come back to play prop firms aggressively, you should be able to pass an entire prop firm challenge in 3 winning trades in a row. If you're not taking all 3 in a row, that is fine because it's very forgiving. You have 5 challenges. If you lose a trade, that's okay, only a -1. And most prop firms have a -10% drawdown rule. So let's say you risk 2% per trade. You can lose 5 trades before losing that account in a row. And if that happens, that's bad luck, or maybe you didn't trade very well. But I'm sure when you shoot for your 35% win rate and you shoot for 1 to 2 and up, you should be good here. And from this point, the game plan is clear. It's all about showing up every single day, hunting for opportunities. I'm gonna give you my entry model in the next part, and you can use this entry model every single day to hunt for opportunities. It's a very easy model. Focus on making very few mistakes. And what I mean with making fewer mistakes is maybe you now blow 3 accounts per week. For next week, don't try to become profitable in 1 week. Instead of losing 3 accounts, aim for losing 2 accounts. Yes, you're still losing, but it's 1 less. The week after, you're not losing 2 accounts, but aim for only 1 account. Yes, you're still losing. Yes, it still sucks, but you went from 3 losing accounts to 1 losing account. And the next week, aim for losing no accounts. Try to go for break even and use these little milestones as momentum to become profitable, but don't try to change it all at once. And that's what we want. We want to get rich quick, but that's not how trading works. If you suck right now, it's okay. Everyone sucks at the start, but try to suck less over time. Go from 3 losing accounts to 1 to break even, and then start building slowly and steadily. And the easy way to do that is by focusing on making few mistakes. So you take a trade, you take a loss, which normal, usually you might re-enter, a little tilted, but now you decide, no, I'm going to close my trading view and I'm going to walk away. Perfect. That's focusing on fewer mistakes. Or maybe you never journal. Maybe it's good to maybe journal your trades once in a while to say like, hey, I took trade X, Y, and Z, and I think next time I can do these kind of trades way better. Awesome. Intentional improvement. Well done. Then you're making fewer mistakes. You go from a 3 account to 2 account, or 2 account to 1 account. You start going towards profitability very soon. And remember, the first funding takes the longest. After that, scaling will go quick, because you reinvest your payouts in more challenges and you repeat the process. And also on identity level, the first funding takes the longest. Maybe you're now in a stage of your trading career where your identity is, I am not a funded trader yet. But the single time you will pass a challenge, your identity shifts. Even if you lose that account right away, you now are a funded trader. You are able, you believe that you can pass that challenge. So even if you lose that account, you now know on an identity level, that's the core value, that you can pass a challenge again. So the first funded account will take the longest. And why not buy 5 accounts on a good prof firm, aim for 35% risk to reward, which is very forgiving, and play the prof firms very aggressively. Yes, those are the 4 steps we just went over. And now it's time to show you an entry model, the exact entry model that passed my first challenge ever years ago. And I'm very happy to share it with you in detail. Let's go to the charts. And here you have it, the school model. And the school model is the easiest entry model you will ever find. It's named to the website we are hosting our group on school. And let's go over the steps one by one. First step is a daily or weekly high or low being swept. So in a bullish example, it's a low. In a bearish example, it's a high. Then the second step is a market structure shift on the 5 minute. And how you can recognize a market structure shift in a bullish example is the last swing low that took the high. If that is validated here at the red line, you have a market structure shift. And in a bearish example, you see when the last low that took the high is violated at the red line, you have a market structure shift. Step 3 is enter in the value gap that made the market structure shift. Target is 1 to 2, ideally towards a opposing 1 or 4 hour fair value gap. So if you're familiar with the external range liquidity, the old highs and lows to internal range liquidity, the fair value gaps, this is exactly that. So your target is a fair value gap. You go from a high to a fair value gap. You go from a low to a fair value gap. Stop loss ideally below the low or above the high. And it would look like this on a long example, and it would look like this on a short example. Now let's go deeper into the charts to see some examples of this happening. Here we are looking at AUD USD on the 1 hour chart. And we see that we swept this Monday high. So we have the first step of a daily high being swept, also a weekly high being swept. And we see a rejection coming in from there. Well, we're looking for an opposing array. We're looking for an opposing for value gap. Here we have that 1 hour value gap. Now let's drop it to the 5 minute time frame to see how we can frame an entry around this. So here we have that same price action, but then on the 5 minute. So we have a sweep here, then we start breaking down lower, and here we have that fair value gap. We actually have 2 fair value gaps. When you have 2 fair value gaps, my strategy is to take it in the first one and allow my stop loss to be at least covering the other fair value gap as well. So let's say you take your entry right here. Your TP is going to be in the fair value gap for 1 to 2. And here we are covering your value gap. We can also, officially you want to do it at the high, but I don't want to take 1 to 1 risk to reward. So I'm okay with putting my stop loss here above the fair value gap. because that is the area that should hold. And let's see what price gives us. As you can see, we are almost stopped out here. So it's good that we allow price to come back into the fair value gap, even the upper one, before going to take profit. And you see how small the trade is. This is like a 3-point stop loss, 5-point risk to reward. And after that, as you will see, it will go even lower. That's the magic of waiting for highs and lows on the daily and weekly to being swept. Because there's lots of buy side liquidity being taken on this move. And that means that price just grabbed a bag of liquidity, a bag of money, and now it has the power to trade lower. It has money to do that. And here we're looking at silver at the 1 hour time frame. And as you can see, we just swept Monday high. Also, we swept a weekly high right here. So there's lots of buy side liquidity being taken. We have an opposing array. That's this 1 hour bullish fair value gap. And now let's drop it to the 5 minute to see if we can find the school model. So we are here in New York session and we start displacing lower. And here's where you might feel FOMO. But let's see what we have here in this price action. We have a fair value gap here on the 5 minute. We also have a small volume imbalance right here. So you can take your trade from this volume imbalance or from this fair value gap. Ideally, I just want to take it from the fair value gap. Target is right here because we only need the 1 to 2. This is an ideal scenario. We can just put our stops all the way up here. This is a very nice stop loss. A stop loss like this will make sure that you have a very high win rate, because price can even go up one more time and then go to the target if the target is meant to go there. And that's very nice. You were not victim to the liquid sweep before the real move, the turtle soup. And that's very nice. So let's see what the candles do here. Price comes here, tags the fair value gap, and then starts breaking down lower. And even if you have missed this one, look at how clean price is after that. So let's say you missed this one. Then from this 5 minute fair value gap, you have another fair value gap being created as a reaction, which is nice. So you could take another entry if you missed this one right here, same target, 1 to 2, and you would have made the money as well. Now the third example, we are looking at the Euro JPY at the 1 hour time frame. And we just swept the Monday low, and here on Tuesday during the New York session, we sweep the Monday low and start moving higher. And when you see that, you know it's time for a school model. We have two opposing arrays here, two 1 hour fair value gaps, because this one is very close to this price action. I don't think we can get a 1 to 2 out of there, so I want to target the upper one this time. Let's drop to the 5 minute to see what we get. So here we have that same price action on the 5 minutes. We sweep the Monday low here, and we see here we have aggressive sells, aggressive buys, and here is where we break structure. So we want the candle that breaks structure to be the value gap to take the entry. So here's the entry. Our TP is going to be that top for value gap for a 1 to 2, and it will be right here. And now let's see if we can get an entry. So price is very aggressive. It goes to the target. Let's see if we can get an entry. It goes back. This is nice. So now we're waiting, we're patient, but we see the price goes to the target without us. And it sucks, but it's all part of trading. You will miss a lot of moves. You can get stopped out before a real move. And this is an example that your bias is good, the school model is there, but you just cannot get an entry here from this 5 minute time frame. And what you then can do is look at maybe other time frames to see like, okay, in hindsight, what could I have done differently? Maybe I can adjust or nuance my entry model a little bit here to get an entry. And what I like to do is zoom out one time frame. I like to go from the 5 to the 15 minute to see if I could get an entry. So here we have that marker shifts on the 50 minutes right here, and there we have a fair value gap right here, and also one right here. Now I'm going somewhere more advanced here, but with two fair value gaps here, why do we not trade to this one? Because we have a breaker sitting right here, the up close candle here, that's a breaker. So here we already have a fair value gap and a breaker. It's called a unicorn setup. So price does not need to come back in the bottom fair value gap. So next time when there is a breaker on this fair value gap, I'm okay with taking it in the first fair value gap here on a 15 minute, stop below this fair value gap to again target a 1 to 2. But it's in hindsight, and I think you should be okay with missing some moves in the process. And this entry model, the school model, will appear somewhere on one of the pairs every single day. You just need to look for them. And as the next example, we're looking at EuroCAD, a 1 hour chart, and we just took the Wednesday low here on Thursday during the New York session, and we start going higher. At that point, where are the opposing arrays? We have a 1 hour bearish value gap here. So let's drop it to the 5 minute to see if we can find an entry. So here we're looking at that same price action on the 5 minute. So during the New York session here at the open, aggressive sells, aggressive buys. Breaking structure is right here. So there is where I want to pay attention. We have two fair value gaps here. We already tapped here into one, but this is not the entry for me. I want to take my entry once structure is broken here. With two fair value gaps, I like to take the first one, allow my stop loss to trade into the other one. Well, with this target, we can have a safe stop loss here for a 1 to 2, right here below the low. And let's see what price gives us. What I'm seeing here as well is failure swings, staircase effect, But for now, let's make it very easy. We have a daily low being swept, the Wednesday low. We have a mark structure shift on the 5 minute. We have an entry and a fair value gap targeting an opposing 1 hour array with a stop loss below the low. Textbook school model. Let's see if it gives us a win. It moves away, comes back to the entry. Don't be the person that puts their stop loss to break even when you have a few pips in profit. Let it ride. Take that loss when it doesn't go your way. It's okay. And price moves higher towards the... Now you know the secrets to becoming a profitable trader. You may want my help to becoming funded, consistent, profitable, and getting those payouts. If that's the case, check out the link in the description to see what the next best steps are for you. How I can help you the best. Links in the description.